Upthrust. I see a lot of familiar faces here. Bill, good to see you from Malaysia, and Bryant, Curtis and Christian. Daphne, how are you? David, Debbie, or Eric. I never know which one of you is which one is actually behind the name. Amy, good to see you. Erica, Chow, Eugene, Gary, Janet, Janice, the list goes on. John, good to see you. Jose, Kenneth, Les, Mike, RL, that must be Ralph Lauren in there, right? Reza, Sanjay, good to see you. Scott, good to see you too. Tallis, Tony, Shai Ping. Now there's a good one. Shai Ping, you've got an Irish last name. That's great. Wesley, William, Tony, and quite a few others actually here. I won't go through everyone, and others are still coming in to the list, but great to see you. And welcome to the webinar. We're going to spend the next hour and a half or so on the Wyckoff Upthrust. It's one of my favorite trades to the downside, and I'm going to show you pretty much everything, well, actually everything I know about it. And we're going to cover a couple of different varieties of upthrusts, not just the common one, but we'll start with that tonight. And Sanjay says it's 12 in the morning in the UK, so he may not be able to stay for the whole session. And that's okay, and thanks, Sanjay. You remind me to just let everybody know that this is being recorded. And I'm checking now to make sure that it is being recorded, and it is. So we're okay there. And we'll process that recording, and we'll have it up in a few days. And Helen will send you the link to the recording, and you'll be able to listen to it for the next several months. All right, so let's get started. Before we start, we always go with a disclaimer here. In the U.S., we have to say that the presentations that we're giving you tonight are for educational purposes only. We're not talking about buying or selling any security or any trading vehicle of any type. We can't, of course, assume responsibility for your trading results, even if you trade this particular setup. We can't guarantee that there would be any change, positive or negative, to your account. And as always, there really is a very high degree of risk in trading, and we encourage you to consult a certified financial advisor before making any trading or investment decisions. And there's more to this disclaimer that you can also take a look at and read at your convenience. And we'll start a little bit with an overview. What I want to do is go through the key elements of the upthrust, and there'll be tons of examples. I think I have more than 60 slides here tonight. So we'll have tons of examples of upthrusts on all different time frames and in a variety of different markets, although I probably err to the side of looking at them in the S&Ps, either the SPY or the E-mini, because that's what I trade most, and equities, which I also trade, but I try to throw in a few of the currencies and commodity markets, because truthfully it works on all of these markets. So we'll see a lot of examples tonight, but I want to first go through the key elements of the upthrust, and I'll draw you a conceptual map of the upthrust. I think conceptual maps are really a vital thing for you to do, so that not every chart comes in and gives us that ideal setup. So having it conceptualized in your head is a very good idea. We're really looking at pattern recognition here, and the patterns are going to vary as they set up because the markets are always different from one moment to the next. There are different players trading, there are different amounts being traded, there's different news, everything is different players. Somebody who was long in the last good-looking upthrust might be short in this one, and vice versa. So everything is different. They're always going to be a little bit different. We'll go and we'll look at some classic upthrust examples, the basic ones, if you will. And then I want to go beyond the basics and start to talk to you about really what to look for when you're looking at upthrusts. I want to talk about weakness and how we can read it. I want to talk about wave structure and how we can look at that in relationship to the upthrust, and a few other things as well. We'll look at, when we go beyond the basics, I'm going to show you a simplified way of trading the upthrust. A couple of different ways to simplify it. And if you did just those with your upthrust, you don't really have to do anything more. I mean, we'll go into real depth on this. And as I say, I'll tell you everything I know about it. But when it comes right down to it, you don't have to go and get real sophisticated about these things. You can do them pretty simply, and I'll show you how to do that. I also want to show you when these will tend to fail, when upthrusts will tend to fail. They're not the Holy Grail. There's no Holy Grail. You're the Holy Grail. There's no trade setup that is the Holy Grail. Although Linda Ratchke has one that is called the Holy Grail, and it is pretty good, that trade setup. But it doesn't work every single time, and neither do upthrusts work every single time. And there are certain times when they're more likely to fail, and I want to show you when those when those conditions arise. And so we'll talk about those. And then I also want to talk about some special situations, the hidden upthrust, which I really like a lot, and I'll show you how I like to use it. And what it looks like, and we'll look at a conceptual map of that as well. And then we'll look at power cells. This is actually not Wyckoff, but a little bit of Elliott wave. I'm not an Elliottian by any far stretch of the imagination. I studied Elliott wave for quite some time and couldn't really make it work as a system for me. It didn't work for me as a trader. However, there are a few things from Elliott that I did find very workable, and one of them is this thing, what we call a power cell. Actually, Linda Ratchke, I think, calls it a power cell. She coined that term, and I'll show you what that looks like. And when we can combine an upthrust with this Elliott wave, the simple Elliott wave pattern, it's pretty powerful. It really is a power cell. So we'll talk about that. We'll talk about how to enter these upthrusts, where to exit them, show you a couple of ways to enter, and I'll show you a variety of different exit options. And then we'll get into the actual details of the trade setup, and I do it in a fairly simplified format because I am a big believer in keeping things simple. And then we'll see a lot of other additional examples and some tips. I'll talk a little bit about how to trade these using multiple time frames when, looking for things like obvious resistance points that every trader out there can see and leaning against that resistance. And then looking at also the multiple time frames or higher time frames. All right. So if you have any questions, go right ahead and type them in. I think everybody probably knows how to use the question box in your GoToWebinar screen, and just type them in, and I won't stop until all questions are answered. So I'll guarantee you that, and I'll try to the best of my abilities to answer every question that I can, that I know. So at any point, just ask questions. You don't have to wait until the end. Otherwise, we'll forget what we were talking about at that point. All right, so let's just look at the key elements of an upthrust. The real essential idea here is that higher prices get rejected. There's really no follow-through to the upside. And that's what we want to see happen here. But it leans up against, or it comes up against, resistance. There's a resistance level that's established earlier, beyond the left side of your chart, the left-hand side of your chart. It might have happened an hour ago. If you're trading intraday, it might have happened yesterday. It might have happened a few weeks ago, and I'm going to show you several examples that are months of that where resistance occurred months ago. So we definitely want to have resistance be established in the background or on the left-hand side of the chart. Some people talk about upthrusts without that resistance. We'll talk more about that as we go deeper into this tonight. It's not the way I conceptualize an upthrust, and I don't think it's the way that the Wyckoff folks conceptualized it either. And you should know, by the way, that Wyckoff actually never talked about upthrust. He certainly talked about thrust, and he certainly talked about shortening of the thrust, but he never created this idea of upthrust. It actually comes from Bob Evans, Robert G. Evans, who I think was the second or third owner of the Wyckoff Associates, which later became Wyckoff Stock Market Institute, and still exists out in Arizona today. But it was Bob Evans who actually created the idea of the upthrust. I think maybe Wyckoff may have known about it, but just never talked about it. There's some indication, especially in his point and figure chart work, which we won't talk about tonight, but there is some indication that he was, understood the idea behind the upthrust, but it really was Evans who created it. So there's a resistance that's established, and the market reacts off of that resistance. And then price comes back up. It rallies back up to the resistance, pushes up above it. It has to go above the resistance. If it doesn't go above the resistance, it's simply just a test. In other words, a double top, if you will. But an upthrust is a different kind of animal. The price goes up above that resistance, and then it fails. And then typically we see a sharp reaction from that and a close either on that price bar or within a couple of price bars afterwards. It closes back down underneath or below that resistance. So really it's an inability to leave the resistance level to go to rally up above the resistance level or leave the trading range that's been formed, if you will. And John asked a good question. Do these key elements apply in all market phases? Well, kind of depends on what you mean by market phases. If we're looking at the phase of accumulation where we're in a trading range, then yeah, it probably would. If we're looking at the phase of markup, and I'm talking about phases in the way Wyckoff would have talked about phases. He had accumulation, markup, distribution, and then markdown. If we're looking at markup or a trend to the upside, if we're looking at uptrending conditions, they occur, but they're not good in an uptrend. I'll show you that when we talk about the conditions under which the upthrust can fail. So the best times to be looking for these is really in the markdown phase or a downtrending phase. Another good time to look for them is in the distribution phase. And Evans had talked about an upthrust after distribution, and actually we won't talk about that because truthfully I've never really traded one. I've never really even seen one. I'm sure they exist. I just have never seen one in the markets that I've traded. I've certainly read about them, from the 1940s and the 1950s when Evans was writing about this stuff. And some of the stocks back then, but I've actually never seen an upthrust after distribution. So we really won't talk about that. But in terms of the market phases, the best time really to trade these is when a downtrend is in place. And we'll talk about that a little bit more, okay? Usually what I see in terms of distribution is that we'll have if we have climactic, an upthrust after distribution requires climactic action, then a sideways trading range, and then the market rallies back up above that climax high and upthrusts it and then comes back down. Typically what we'll see is after a climax occurs, and we don't see too many climaxes even, these days with so many players in the market. But when we do see a climax, usually we'll see the market fall down and never really come back up to that climax level, and we will see a range of secondary distribution. We might see an upthrust there, but that's not really an upthrust after distribution, at least the way Evans talked about it. All right, so what we're really looking at here is supply and demand being assessed, and we can see that, and we'll talk about the details of this. I don't want to talk about it too much in the abstract here, but we'll see it in the width of the spread or the range of the bar. We'll see it in the close, and we'll also see it on the amount of volume that comes in. And what we're really seeing in most instances in an upthrust is supply overcoming demand. We might also see just a lack of demand up there, especially when the volume is light on the upthrust. But then we should see pretty quickly after that supply coming in and swamping out demand. Okay? But the key essential idea here is that higher prices are rejected and there's no follow-through to the upside. All right? So let's look at a conceptual map here of an upthrust. Here we have some sort of a high here made at A, and this is the resistance level that I was talking about that you're going to see on the left-hand side of the chart. So we have this resistance level come in at A, and then the market reacts from that. Okay, we'll talk about this reaction after we get beyond the basics, because I think this reaction is a key element in looking at high-quality upthrusts. And we'll talk a little bit more about this in the examples. But we react, and then the market rallies back up. And on the rally, we see this market push up above the resistance at A, we're now over here at B, but fail at that point. And the market, instead of going higher, or instead of coming and maybe testing here on the testing that resistance level, finding support, and then going higher, this doesn't happen. It doesn't follow through to the upside. Higher prices get rejected and the market falls. Supply comes into the market and swamps demand. Okay? Is that pretty clear to everybody? Does that make sense to everyone, this conceptual idea here of how the upthrust works and how we would see it? Okay, good. John says, would an upthrust be the same as a failed breakout in technical analysis? It could be, John. It could be. If that failed breakout is coming in at a trading range or some sort of a rectangular formation, and the market tries to come up, fails up here, and then comes back down into the trading range. Yeah, that could be. However, you know, if you're in a triangle, we will often see a market come up through and fail. But so this would not be an upthrust here. You might be able to make an argument that it would be upthrusting this, but if it were, you know, true technical analysis in terms of a triangle, either a symmetrical triangle or an asymmetric triangle, it really wouldn't be an upthrust. So it would you'd have to look at it on, you know, different in the different patterns that are setting up in technical analysis. But the general idea of the market failing and creating a trap for the bulls, right? This would be a bull trap here. Because everybody's jumping on board, breaking out to the upside, so they're going long here, and then it fails, and then it comes down. Then that would, yeah, that would be a, it would be a failed breakout, and would be very similar to an upthrust. Okay. All right, good question, John. All right, so here's a classic example, or an example of a classic upthrust. And here's crude on a daily basis, crude oil. It's the March contract, last well, they're probably trading more contracts than this now, but this last March here, where again we see a high created here, a resistance level created. The market comes down, reacts. We get a rally up. It tries to go up, and note here that it tries to go up a couple of times, and it looks like maybe, here it tries to break up above, and then the next two bars are holding, right? And then it goes up, but it finally comes back and closes underneath, okay? And this is, any of these really could be considered the upthrust, but I would call A to be the decisive bar here, that really where prices really to the upside really got rejected. Okay, that was a fairly decisive. And then supply comes in, swamps the demand, and we get a big sell-off of over $10 a barrel down here. Okay, so that's a nice classic example where we have that level of resistance put in over to the left-hand side of the chart. And notice this starts off in, this is October 25th or so, and it doesn't come back in until the middle of January. So there's a fairly, one of the key things about an upthrust, especially the classic kind of upthrust, there needs to be, and there's no set number, I don't know how many bars there would be between here, but there needs to be a number there needs to be some time that's occurred between the resistance level that's created and the upthrust. Okay, we don't just upthrust the very next bar and call that an upthrust, or we don't just come up and, within one or two bars here come back up. Let me draw this for you. We wouldn't say if it comes back up here on this bar and then falters like this, we wouldn't call that an upthrust. That wouldn't be enough of an upthrust for me. Again, this is pattern recognition, so there's no, I can't say, well, you have to have 45 bars between one level and another. That's not the way, sort of a judgmental system works. You're assessing supply and demand. You're not trying to frame this in terms of a formula per se, but you're looking at supply and demand come in. Here we have the market gets stopped over a number of days. It comes down and reacts, and on the rally back up, it hangs up here for a few days and then decisively it becomes clear that it's unable to rally any higher. And so this is the judgment part that comes in. Okay, it got stuck back at this resistance level. The entry on this chart, well, you could enter this in a number of different ways. We'll talk about entries in a little bit, but just a straight entry would be on the close of bar A, or any of these bars really, but bar A, and you would stop it up above the high of it. You could drop down to a smaller time frame and do that if you wanted to. You could wait for what VSA calls a no demand or a test of the upthrust. We'll talk about that tonight in a little bit more detail. But I tend just to go if the risk isn't too great, and sometimes, and here's a good example where you've got a fairly widespread bar. Remember, we're talking about supply overcoming demand. Well, here on bar A, we have that same kind of thing going on. We have, now notice this is October of one year, and then we're back into December of the same year, actually. Excuse me. A couple of months here of sideways movement, and then we get the upthrust. Higher prices are rejected, and now on this we have a clear rejection of prices. I mean, it doesn't get much cleaner than this, where the market rallies up high, a couple of points here on this stock. This is a NASDAQ stock, and then it closes back underneath the resistance level that was established over here. And a lot of times on these upthrusts like this, you won't get a second opportunity to get in because it'll just start to fall. And this is a good example of where supply is just coming in and swamping over demand. And we see all that supply coming in the volume. if all that volume were bullish, and there are a lot of buyers in here, don't get me wrong, but the way it's closed just tells you, screams out at you that sellers got in control. Buyers tried to push it up higher, and sellers came in and just swamped it and managed to close it underneath the lows of, underneath the high of the resistance of a couple of months ago. That's pretty decisive. And then it falls from there. If you didn't get in on the upthrust, then you have to wait. You know, the way that I would trade this is I would wait for a weak rally. You get that weak rally here, okay? And you could take a position at that point. So that's a nice clean example of an upthrust. Trading is more art than science. Yeah, it is. There certainly is a lot of art to it, but I would say that trading is a lot more judgment than it is maybe art or science, and that it is learning how to read the market by its own actions, looking for some of the telltale signs that help us to determine whether supply or demand is dominant at that moment in the market. Okay, so but you know, I can't say that it's not. It is more art than science. But when people say that, Xiaoping, what they often mean is that, well, it's really hard to do. And yeah, it is hard to do, or it takes a special talent. And it is hard to do, but it's not impossible either. But it just takes an awful lot of effort. It takes a lot of, you know, seeing a lot of this stuff. And also you might go in on some of these things and, you know, you might not get much of a, you might get stopped out. You know, these are not foolproof, and you have to be able to accept being stopped out. Okay, good. All right, so here's another one on the, I like trading this on the Russell too, the Russell 2000 E-mini type futures contract. Here it is on a 5-minute basis. And we have a situation where the market opens up here in the morning, kind of tests down below at whatever level this was, rallies up, and then can't go very much further, right? We see that, you can see that shortening of the thrust. We're going to talk about that, so don't get excited if you're not familiar with the term. I'll explain what that means. But for those of you who've been in my classes or who I've worked with, and there are a number of you in the group tonight, you can just sort of see this. If you just step back and sort of soft focus your eyes on what we have before us on the chart, you can see that, you know, there was some nice movement here, nice acceleration, nice impulse, nice ease of movement here. There was a little bit of an attempt here for ease of movement, right? But as we're trying to go higher, volume is drying up. We're sort of rounding over with that shortening of the thrust, and we get this upthrust action here. And here's an example where, you know, I try to pick out some that are not just textbook here, but that are real life. You know, so you take the upthrust right in here on the close of this bar. And then, you know, you'd set your stop at the high or maybe a little bit above. I tend to just set it right at the high because usually if it's going to go up and go to that high, it's probably going to go through it. So I'm usually out at that point, although that's not the normal way people trade, set stops. It's just the way I do. In any event, you know, you're in this case, you're sitting through a little bit here, right, of pressure, I guess, or, you know, you're feeling a little bit of, gee, how come this isn't moving? And if you were taking a time stop here, if you had, you know, if you weren't getting profit in a couple of bars, you might exit out of this, but then you miss this move, right? Or if you didn't get in here and then you saw this and you said, boy, this is really weak. This is twice that, here, I'll erase this. This is twice that in this one time here and another time here that they couldn't bring it up higher above this resistance level. I'm going short here. Well, if you were lucky enough to get in at that point, bang, there it goes. And this is what a good upthrust will sometimes look like, especially in the intraday E-mini trading. So it's kind of nice there that this trade is available for us. But like all things, nothing is really 100% free for us. So sometimes it doesn't work out immediately, or it doesn't work out as cleanly as we'd like. Okay, and we can, maybe we jump out of this trade. If we got in here, we jump out of this, and then we're sitting waiting to see what's going to happen, and then it does what we thought it might do, and does so in spades here, and we're sitting on the sidelines. Well, that happens too. Happens to me sometimes. That happens to everybody. And it's right at the 2:15 reversal time. Yep. Lars asks, am I going to talk about the way volume should behave? Yeah, I will a little bit, Lars, but I'll tell you what, I think volume is much less important in an upthrust than the price bars itself and the background. And I'll talk more about that as we go on. Sanjay says, is the bar at 12 o'clock also an upthrust? Let me erase this. Okay, technically, yeah, it is. So Sanjay is saying here at 12, we have this bar, and it's coming up and upthrusting over here if we drew our resistance line in here. Yeah, it is, sort of, except that you got strength here, okay? So I wouldn't be inclined to take this because of the strength. Why do we have strength? Because we have movement coming up here. Volume is expanding as the market's rallying, and this is definitely weakness over here when we see this upthrust type bar, and no question that we've got less volume here, and maybe this just comes from experience and sitting through a number of years of this stuff, or just a number of going through and really deep practicing this stuff. Yeah, I just wouldn't want to take this trade here. Technically, it's an upthrust, but I'm looking at this and saying technically it's an upthrust in an uptrend. We have a higher high, a higher low, and a higher high. Why do I want to take that? Okay. We also have a higher high and a higher low and a higher high over here, but here we've also got this shortening of the thrust, right? And we have an awfully long time going sideways here, or basically going sideways. Here's a tidbit for you, but it's a good one. It's a very useful thing to know. The longer the market goes sideways, the greater the odds that the current trend is about to change. So what do I mean by that? Well, if we can say that this is an uptrend here, but if we look at the amount of time we've gone sideways and compare that to the uptrend, it's very little time that we're in this uptrend, lots of time going sideways. So what does that tell you? It tells you that there was some buying going on in here. It had to be, because it drove it up. But there was an awfully long period of time where the opportunity to go higher didn't materialize. So if there was real buying going on, and folks wanted to, if the buyers wanted to continue to push prices higher to make good on their buying that went on in here, they would likely do so earlier on. But instead what we see is this long sideways line, this long sideways, trading range here of sorts, or a movement sideways. And it tends to negate what was going on before, because it gives everybody a chance to bail out of those long positions who can read the market well, and it gives others a chance to sell into the market to folks who are trying to buy in through here and get short. And then you see this kind of action occur. All right. So, Sanjay, I hope that answers your question. It's a little bit of street smarts, I guess, or market smarts here, knowing that yes, this is a bit of an upthrust, but we're much more in an uptrend here than we are over here. Okay, hope that makes sense. Would that be a cause formation for lower price? Erica, good question. Yeah, it could be. Erica asked a very good question. Cause. Cause is a Wyckoff term. Yeah, I think it's a Wyckoff term. Well, I know it's a Wyckoff. They talk about it as cause. I don't think anybody else talks about it as cause. But the more, if you were looking at this on a point and figure chart, you would see there would be, you know, figures going up to represent this rally. And then there would be a lot of figures here going sideways. And then we get that little upthrust, higher prices get rejected. And the amount of sideways movement will give you a sense of how far you can count. If you were doing a point and figure chart, you could actually get a count off of these figures and project from this level here, and there's other ways to project it, but the basic is to project it from that level and give you a sense of where the cause would bring the result of lower prices to. So yeah, it would be, that's a very good way of thinking about it, Erica, is that you would have that sideways movement is really cause, and if it gets too long and then breaks down, and then you can think about that in terms of how far the market is likely to go. Yeah, and when we in a trading range, when we do not see demand coming in, then we can anticipate lower prices too. Yeah, absolutely. We're getting a little off track here, but that's okay. I don't mind doing that. Here we have a trading range, right? So even if we don't know that this is, even if we didn't know about upthrust, let's pretend we didn't know about upthrust here. So just look at this. We've got a nice trading range here, and we're saying, well, which way is this going to break? Well, look at this. As it's coming down through this trading range, it tries to go up. We could make this, you know, we could logic this out. And really, Wyckoff is all about logical reading of the charts. It tried to rally up here, and it failed, right, up in here. And now look at it coming down here. My goodness, this is, we're seeing volume increase. Whoever was long is bailing out. There's a lot of supply coming in. And it doesn't stop at the bottom of the trading range. It stopped down here the last time. This time it just knifes right through, right? So that, just from that, those two clues here, those three things. Number one, higher prices get rejected. Number two, we're coming awfully fast down through this trading range. And number three, we knife right through it and drop down lower. What does it tell us? Well, it tells us that supply is in control and that the odds of taking out the morning low here, this AM low, are pretty good. So you look for an opportunity to short in here if you can find one. And that's exactly what happened. Okay. What the upthrust does is it gives you kind of a head start on all of this because you can get a position going. Even if it's not a full position on, you know, you don't have to put full positions on. That might be the more of the art in a lot of ways of trading is looking at position size and how you do that. But in any event, you know, you might start here. The upthrust gives you a head start, and if you were fortunate to put a short trade on and you started to see this, you want to hold that for everything you got. You know, you want to bring your stop down to about here, and then just I would hold it all the way through until into the close if I saw something like that, because it just says that supply is really swamping in. We're not looking at any, you know, we're not looking at hourly charts or daily charts or higher time frames at all to see what the trend is. We're just looking at this one thing and just kind of stepping through it logically. So, you know, this is a nice example of not just taking an upthrust that's not real clean in here, but then being able to read the market and then manage your trade properly to try to get the most out of this simple little upthrust trade. Okay. All right. Now, a bunch of questions. Kind of got that, kind of expected that. Okay. Jose says, is that what they also call a measured move? Jose, good question, but no, it's not. A measured move is something like this. A measured move would be, And I did that too big. Measured move would look like this. Let's say A was, I don't know, I'll make this up, 10 points here, okay? And B was 5 points. Well, we would expect C to be very similar to A if we had a measured move. So we would expect C to be around 9 or 10 points, okay? And when this reacts again, we would level D, we would expect D to be similar to B and be about 5, 6, 7 points, somewhere around there, okay? So if D is a lot larger and D gets to be, say, 10 points, then we know that there's been a change in the wave structure. It's another way of looking at the wave structure here, okay? Yep, supply. Sellers take control. Exactly right, Erica. When we're talking about supply, we're talking about selling coming in and taking control of the market. And Erica also says, is this right here, breaking of the ice? That's a Wyckoff term. Again, comes from Bob Evans. This a little story, the breaking of the ice, the support level is ice. There was back in his day in the 40s and the 50s, everybody knew Boy Scouts, and every family probably had who had a boy in their family probably had a Boy Scout in their family, and he used to create little stories to try to explain some of these concepts. And he would talk about a Boy Scout walking along the ice, but it gets too thin out here and he falls right through the ice. And tries to come back up on the rally after this, but bumps, now he's kind of gone downstream a little bit and bumps his head on the ice. This rally doesn't come all the way up, but often we will see this in the kind of classic. We'll see the rally come up to the back up to the edge of the ice. The Boy Scout bumps his head and then it falls, and then, you know, the market continues to fall. But that's the ice story, right? And you see that here. I find that it takes art to exit well, not to be too far off topic. Yeah, Bryant, you're right. That is part of it as well, is finding exits, and we'll talk about that. Can I use an FX chart for an example? I probably don't have, Christian, an FX chart in here. You'll have to find those for yourself. I don't remember if I do or not. Maybe I do. I think I've got some currency charts. I think I got the Aussie and the dollar and the British pound and stuff. So you'll see that. I don't trade FX. I don't really like trading at FX, so I don't really have those. Erica says sometimes it's important to pay attention to see if we have strong or weakness coming in or bars coming in at support and resistance, and see how the market responds to those. Yes, that's right. It is, and we'll talk more about that. The range in the, Laura says, the range in the picture, wouldn't you call this a kind of distribution? Yeah, it is a bit of a distribution. Sure, and that's what I said. We had some buying come in here, but there's been plenty of time for sellers to come in and sell into this market and build up a line of shorts, or to take the buying out, or the buyers who bought in down in here to sell out at higher prices and take their profits. So yeah, it is kind of a distribution, although distribution in classic sense would have a climactic action, an automatic rally, testing of that, and then a fall through the ice, which we don't really have here. We're only on a 5-minute chart, so it's not that big. Why, may I ask? Oh, because of no. Why don't I? Because I don't trade FX. It's not the market I trade. I just don't trade it. Okay, good. Yeah, it is like figuring out a puzzle. It sure is. Okay, so let's now start to go beyond the classic, and we actually already started to go beyond it because I got deep into the chart. And this is how you got to look at these, in my judgment. I mean, this is a way to do this. If you want to do this kind of method. Okay, so background is really important. And we started talking a little bit about background, especially on that last chart. So let's talk about some of the elements that will add to the upthrust. One is going to be obvious selling at the resistance level, where we see the market got turned down decisively there. All right. I'll show you a couple of examples of that. A lower low in the wave structure. Wyckoff talked about waves. I think it's David Weiss taught me a lot about waves, and I really pay an awful lot of attention to wave structure. So we'll look for things like a lower low in the wave structure. We'll also look for something like shortening of the thrust as well, which we talked around, and I'll show you what that means. Also, no significant indication of strength as it's rallying back up to that resistance level. So in our conceptual map, as it's coming back up to this level A here, we want to see no significant indications of strength here. Remember we saw that the market's falling down through the trading range? Well, we don't want to see that on the upside coming up, right? We don't want to see that kind of strength coming up. It's just the opposite. Heavy or light volume and no upside follow through at the upthrust. We want to certainly see that. And narrow ranges at the upthrust. Few folks talk about this, but it's a pretty interesting and useful thing to know, to see some narrow ranges there. Okay, so here's a pair of upthrusts that occur. One's a little bit tight in terms of the distance here. That's this one. But it would be one that you could consider. Why? Because look at all the selling that's occurring here. We get really rejected prices. Look at the volume that's come in. This is a daily chart of a stock, right? Look at all the volume that comes in as this market sinks lower. And look at the spread compared to everything coming up. We get a little bit of kind of climactic action here. I think that's on this volume. And then we get more heavy volume coming in on this bar. So and the spreads here, or the ranges, these two bars, and you look at that and compare them to the ranges or the spreads on all these bars coming up, these are larger than anything we've seen so far, okay? That's clear selling at the resistance level. We're seeing real selling coming in here. Some interest, some sellers are coming in force. Note too, we get a little swelling of volume in here. Right? And we start to see volume coming into the downside. Wyckoff talked about swelling of volume occurring at the ends of trends. We've talked about that in the classes that I've talked about. We spend a day just looking at volume spikes and what those mean. They typically will turn the market, or have a chance to turn that market. So we see supply come in here. When we get back up to this level, when we get back up to this level here at A, what happens? We get rejected, and look at the supply that comes in here. That's what we want to see. If we're looking for weakness, this is the kind of response we want. So we come up to this level here, this resistance level that was established where some clear selling comes in. We come back up to it at A, and look at the response. The response is simply supply coming in and swamping demand, right? Well, now we get back up here at B. What is that telling us? Look at supply. No demand as we're trying to rally up. As we're trying to come up, volume is going down. And then we get that decisive upthrust right there. More supply. So we have all of this in the background. And when we get back up into this level, we've got these lovely weak bars here. These high tops or high tails and low closes, and the weak rally coming up. At this point right here, it looks like it might be trying to come up above the market. You wouldn't know for sure that this was going to turn around. You don't know until, you never know for sure, but you don't know your odds are good really until, these bars in here. And you could maybe take an upthrust in here and you might get stopped out, but you'd go right back in again. Again, I'm trying to show you things that are not just textbook, not just, crystal clear, nice, clean ones. I'm trying to show you real life stuff. And so what? You get stopped out for a couple of points here on this, or not even not even 2 points. You go back in again here, and you've got 10 points or 9 points anyway, 8 points in this trade. So, or if you may not feel comfortable with trading upthrust off of the upthrust. That's okay too. You wait for a weak rally to come in, or you wait for a no demand, and I'll show you better examples of that in a bit. Or a hidden upthrust, which we're going to talk about, and there's one right here on this bar here. There's a bit of a hidden upthrust there that you could go in on. Okay, so there's other ways to enter this, and we'll talk more about that. But just knowing this setup is occurring here, if you saw this and you on the daily chart in your day trading stocks, then you'd look on a 60-minute or a 15-minute chart, and you'd be looking to the downside for the most part on this, and you'd be looking for it to break, and then again it does. Okay. From my experience on a daily basis, do you find that entering the upthrust late in the day of the upthrust is more effective than trying to catch it the next morning? I would say generally, Janet, that's true. When we have a bar like, it kind of depends on the bar. If we have a bar like this, even like this one here, but this bar B is a clear example. When a market does something like this and closes on its low, there are really good odds that we're going to see follow through the next day. And you can see even on this early upthrust bar that didn't turn the market down decisively, the next morning still gets follow through to the downside. Okay, so when we see these, Toby Crable calls these hook type bars or hook type days. I just call them like a reverse key reversal bar, or one that rallies up, falters, fails to go higher, and then gets creamed really by the sellers and closes on their low, on its low. Usually when they're not everyone, like here's what's a good example? Let me see if I can find an example. Not everyone is going to do that. Well, now I'm not finding any examples. In any event, not everyone is going to do that, but most of the time, especially when you see it up thrusting resistance, you're going to see follow through the next day. So yeah, I tend to like that. And John makes a good point. Sometimes we'll get gaps down, right? And everybody understands a gap, right? Here's an example. We close here on this bar. The next morning opens lower. Right, the open would be probably around the high here on this bar, and we get that gap. It's the difference between the close and the open the next day. You see a lot of gapping going on. It's useful to pay attention to gaps. Is it a good idea to compare at that level the volume from the previous high? Yeah, sometimes it is. Here we're seeing the previous high, we got a lot of volume in here at the top of a rally. Here we're seeing volume. This goes with this bar here, so we see some buying coming in here. But here what we're saying is that volume isn't, if I drew a line straight across over to here, we can see the level of volume, right? So volume here is not in keeping with the same level of volume that we had over here. So yeah, it's a good observation, Erica. There's less buying going on in here, and that's another thing to help us out. Exactly. Good observation. Okay, here we see some more weakness at resistance. You can see the resistance line here. I didn't label this A, but you can see that we had a high volume coming in. It's the beginning of the day. This is a 60-minute chart in SPY. But it closes right down on the lows, and then we come down, right? But one of the things to note here is shortening of the thrust. If we were to look and see that every time we rally up here, we make pretty good progress going up, right? We go to this level, and then this level, and then this level. But then look what happens. We start to rally here, and we go to this level. Not bad, but then up here, what happens? We get this level here. So our progress from 1 all the way up starts to shorten here. Let me erase this and show it to you a little bit differently. we were to draw a little graphic and we were to say, okay, so we got a rally to here and a rally to here and then a rally to here and then a rally to here and a rally to here, you can see how the progress got short right in here compared to here and even here. Okay, that's what we call shortening of the thrust. And you can sort of see it as a arching over. You can see it as a kind of arching over here. So we have supply coming in at this level, and we have shortening of the thrust over here. And then notice, too, that we get a little bit of a change in the wave structure. This is not a bad chart to talk about this. Every down wave we had, this one's not that big, right? Once we get going. Here we don't even go down, we just go sideways. Here we're going sideways again. A little bit of a bigger down wave, right? But in each case here, the up waves are larger for sure than any of the down waves, right? Even here. But notice what happens here. This is what we call a change in the wave structure. The down wave got larger than any of the preceding down waves, and also it got larger than the last up wave or two. So now we have shortening of the thrust, we have weakness come in on the very open of this day here, this first bar, and it takes the market down for 2 days, causing on this time frame a change in the wave structure. Okay, so now as it rallies back up, and Erica would observe this, that if we look at the volume, as we come back up here, volume is, you know, somewhere around a little bit better than half of what it was the last time we were up at this level. And we don't even get to go very far up above the resistance, the high of the resistance there, and then it comes down. And then it just takes the market down from there. Okay? So that's another way. What I'm trying to emphasize here is not just look at these things, look for resistance, and then look for the upthrust. You know, you could do it that way, but your odds are going to be probably less than 50-50 in terms of good trades coming out. When you can start to pair things like shortening of the thrust, change in the wave structure to the downside, increase volume and supply at the resistance, you know, clear selling coming in at the resistance level, well, now you've got odds stacked better in your favor. When you do see this upthrust bar, you can feel more confident going in because you got all this stuff behind you. There's still going to be times when this is going to turn around, hold, and go higher. Absolutely, even with all this in the background. But you're going to have many more of these go down and go in your favor when you can lean against weakness in the background. Okay. All right. Yeah, Erica says this is almost 99%. I don't know if it's 99, but it's got high odds. That's right. If you can test that and see the change in behavior and all of that sort of stuff. Oh, absolutely, Erica. This is my plan for short trades. Yeah. The 1, 2, 3 pattern is present to the left as well. 1, 2, 3. I'm not sure what a 1, 2, 3 pattern is, Jose. Oh, I know what you mean. The 3 pushes up. Yes, yes. Sorry. Yeah, that's good. That's a good observation. We will often see excellent observation, Jose. Yeah, I wasn't sure exactly what you meant there. We'll often see prices, you know, we don't really have climactic action here. Maybe there's some climactic action here, but it's driving up through this, so I wouldn't characterize that as climactic. But what we'll often see is 3 pushes up or 3 pushes down. Here's 1, here's 2, and here's 3. Okay? And that will tend to stop a market. Sometimes it just goes sideways or we get a little bit of a reaction. Here was a nice indication where we had an upthrust. So there's another thing that you can add in, 3 pushes. That's been a, you know, I don't know where that originally comes from. I think it's Elliott. You know, that's like a 5-wave impulse type move. But I'm not sure where, truthfully, where that comes from. But traders have known that for decades, known that pattern, and it certainly exists there. 3 drives, yep. You call it. They're different. People call it different things, but yep. When I say shortening of the thrust, do I take into consideration the spread or range of the bars, or just the progress the market is making, or both? Good question, Curtis. For the most part, I'm looking, in this kind of an instance, just the progress that's being made. There are a shortening of the thrusts of price bars as well, and in a way, the upthrust is in its own case a shortening of the thrust in the price bars, and also in the what Wyckoff would have called the thrust, or the move, the drive up. But here what we're really talking about is shortening of the thrust in the drives, or in the rallies up here. Good question, though. Linda Ratchke talks about it when it comes to indicators, doing it with price. Yeah, Laura, she does. The indicator she uses, which I actually use too, it's a really helpful indicator. It's the 310. It's a very sensitive indicator, and you will often see it clearer or cleaner in the indicator than sometimes you'll see it in price. So yeah, that's a good observation there. And the same thing happens on the bottom. That's right, and it works to the bottom as well. Here's 3 pushes down. Look at this: 1, 2, and 3. There you go, Erica. Good observation. Good comment. But we're still talking about weakness tonight, not the strength. But yeah, things happen like that all the time. Look at this one. This is a weekly chart of Goldman Sachs, one of my favorites. And here, let me ask this: what's the weakness here? I kind of say it, supply in the wave structure, but why is it weak in this wave structure? Why is there supply why is there, I call it, significant weakness here? Why is that occurring on the weekly chart here? Lower low, right? A lower low. And there's cause, there's definitely cause. And this is one of those instances where you have secondary distribution over in here. It's kind of a classic Wyckoff way of looking at the markets. Here's what I see in this chart. This is down in October 2008 over here. And this is that waterfall, that cascade downdraft that we had when all the banks were under siege, and Lehman Brothers went under, and Bear Stearns went under. So there was enormous panic in the markets at that time, and this volume is really dwarfing everything else. I don't know if there's ever been before or since this level of volume on a weekly basis in Goldman Sachs, but in any event, right here, look at the volume here. So if we took this volume bar out, all of this would expand, and you would see that this is large volume, the largest volume on the chart, and look at this wave down, right? Remember we were talking about wave structure and the change in the wave structure. If we were looking at this, we got a nice wave up, pretty good one down, a nice wave up, small one down, one up. Look at the size of this one, bigger than any of the down waves we've seen, all right, before, and certainly larger than this up wave. Well, if demand were still in the market, we wouldn't see this. We would not see this. We would see something like this, or we would see something like this. But instead, what we see is supply come into the market, and it's punctuated by the high volume coming into the downside, okay? Now, it looks like we're going to rocket to the moon on the way back up, but this really changes the picture, okay? Took a little bit of time because there were still a lot of buyers, but we get the upthrust here, and this is on a weekly chart. And this took us, well, it didn't take us, but all of this weakness that came in was capped by this upthrust, and it brought us down to the bear market lows of 2008, okay? In 2009, well, 2008 for Bear Stearns anyway. It's an interesting chart. It's one worth studying. You can see this in SPY. You can see this in any of the charts for the most part, but Goldman Sachs happens to be a particularly good one to look at. But that change in the wave structure, that supply in the wave structure, and then we get an upthrust. Gee, it's just, you know, it's kind of screaming out at you that this is where you want to make the, you know, the odds are in your favor, so this is where you want to make the bet, so to speak. Okay, so that's a weekly chart. We'll go down to a 5-minute chart now. And here we have kind of the opposite, a little bit of lack of demand. We have our resistance level here put in the overnight market, and we come down, and we won't talk about wave structure because we really don't know what the wave structure was down below, but you can kind of see that the down waves here are increasing, right, as we come down. But we do turn that around and we come up. And it's unclear. I've got these bars marked 1, 2, and 3. It's really unclear on bar 1, certainly, and even on bar 2, what this market is going to do. We don't know if it's going to go higher or not at that point because, look, volume's coming in as the price is moving up and the range of the price bar is expanding with the volume. Gee, I would have to say buyers are probably in control here, right? In fact, I would say buyers were in control. And if I were long, I would be thinking to myself, it's going to break the overnight high, okay? But the very next bar, this is something contributed to, that Tom Williams has contributed. It's called a no demand bar. No demand is usually an up bar, meaning that it's closing above the close of the last bar. And it's typically on a narrow range or spread, narrow range or spread. But the key is, the key are two keys here. The narrow range is important. But also, look at the volume. How come all of a sudden we go from good, strong volume and apparent strength in the market to nothing? Well, that shouldn't happen. What we should see, if this were really strong, is we should see this push up and we should see volume continue to increase here, okay? But we don't. We see what is, in VSA terms, a classic no demand. And then we get the upthrust right after that. We rally up and close beneath the high of the resistance. And notice, too, on this bar, the close is here. We're closing down at the low of this prior bar, pretty weak, right? And we're closing under the close of bar number 2. So if this is like a second indication of weakness, the first one being this bar number 3, this no demand bar, and the second being the actual upthrust bar, and particularly the way it closes. And take a look at the volume that comes in, okay? Now, volume's not always important, but here it's telling us that supply is swamping demand because we're closing so poorly and closing poorly in relation to the previous 2 bars. And we're closing underneath resistance, and we're doing so on big volume, okay? And I think I have a result here. Yeah, so look, here's the result of this. Look at what happens. We start to fall off, and there's a good, you know, however, almost 10-point move here, which is not bad in the S&Ps. Now, I put in, you know, for those of you who want to look for other entries as well, here's a no demand or a test. You know, VSA calls them no demands. We could also consider them as a test of the upthrust. It tries to rally up. This bar number 4 is very similar to bar number 3 in that it's narrow in the range. It's an up bar closing above the bar before. So there's an attempt to rally up, but there's just no volume behind that rally. It's really a lack of demand. And it is testing, if you will, this supply that came in on the upthrust bar, and it's saying that that supply is good, that there really is no buyers coming in at that point, and then the market falls off from there. Not a great fall off. We don't see like that Russell 2000 where the market just fell hard. We don't see that until over here, and then it doesn't really fall all that much. We're kind of in a trading range in this day, and that, that's not atypical in the S&Ps. And again, I'm trying to show you nice examples and then some examples that are so-so. I mean, it's not bad. It's 10 points. That's pretty good in the S&Ps, but there's a bit of a scary rally here. I'm not sure I would have stayed in this trade if I were in it. Looking at that. Okay. Narrow ranges is another thing to look for. Here we have FXI. This is the China ETF. ETFs are nice to trade this stuff with too. We have the resistance level put in over here, and not real clear resistance, but once again we have a larger move down in the waves than we've seen prior to this. Okay. Something I really like to see in my regular upthrust. I like to see that lower low. That's another way to think about it, but I just like to see that wave structure, really start to change to the downside. But then we rally up, and here's the rally. Now we don't get big volume. There's a little increase in volume, but gee, not all that much, and it's less than what we were earlier. But the key thing here is look at the spreads or the ranges in the price bars. They're very narrow. When we're breaking out, if a breakout is going to be a good solid breakout, we don't expect to see narrow little ranges there. What we expect is those ranges or those spreads to start moving up and demand coming in and all of that, right? We want to see that coming in, not these narrow little spreads. So the narrow little spreads or ranges are telling us that there is a lack of demand at this level. If we saw really high volume in here, right? If we saw volume coming in like this, and the ranges were narrow, we would say that somebody was capping this market. In other words, sellers were coming in, and there were a lot of buyers there, but there was a big fight, basically, and sellers were successful in keeping the market from going higher. So it doesn't. The volume is probably less important than just the ranges at that level. They say sometimes we can go up on no volume, no supply. When can we know that we have no supply? It's a good question, Erica. When they talk about going up on no volume, it's usually in the early part of a trend. As the market's moving out of a base, it can certainly go up on light volume. It can continue to go up as well and make new highs on light volume. We saw that earlier this year in the S&Ps. What we're talking about here, though, here's the key distinction, and it's this right here. When we're going up and there's light volume in here, when we've already had a resistance and we're not able to break through that supply, there has to be supply here to have turned the market down. Okay, some supply came in. Now, when we come back up here, if we're just going up on light volume, it's most likely a killer for that. Most likely it will turn this market back down because there's not enough demand to pull the market higher. When it's first starting out, here we're kind of going up on light volume. It's not a good example, but if we were just coming off of these lows and we're rallying up and we're doing so on light volume, or if if we'd already gone well beyond the resistance and we were making higher new highs and the volume was light and we were grinding up, that kind of low volatility grinding up move on fairly light volume. That's actually a fairly strong trend. And so we can see it there as well. When we don't want to see it is when we're breaking out. You don't want to see light volume on a breakout normally. Do you enter market on the close of that bar? Generally, yep, I do. Okay, if I were to enter that one. That one I probably wouldn't because the clean entry is here. because remember, we have to close beneath the resistance, and that doesn't occur till here. So that's a tough one because you've got to stop it up here, and that might be a little bit too large of a stop for my trading account, so I might wait for the next, intraday to take that trade. But generally, yeah, if it's within mine. And here's the follow-through on that. You can see that it was turned out to be a nice trade to the downside. And FXI is a fairly volatile stock for these. Here, we'll see them on all different kinds of scenarios and situations. Here's the S&Ps on an FOMC announcement day where we get all this churning, right? And we get all this supply coming in. Look at the supply that came in here. Now, I'm not suggesting that you trade this necessarily on an FOMC day because it's hard to trade them. And if you're not really experienced, and even folks who are really experienced often don't like to trade these, trade on an FOMC day. I shouldn't say trade these, but trade on an FOMC day. But even if you're not trading that on an FOMC, you can also, you can note this when this upthrust occurs, and you can look for a trade in here somewhere, okay? So they occur all the time on all different time frames and all different scenarios, and those are some ideas for how to think about background. Now those are some of the more, well, I don't know, not necessarily sophisticated, but it takes a trained eye, I guess, to be able to really see this and make the judgments real time as the trading unfolds, as the price and the volume unfolds. So I want to give you some simplified ideas too, okay? And if you just stuck to these 2 or 3 things that I'm going to show you next with your upthrust, I think you have the potential, I should say, not that you will do or won't do, but you have the potential to do pretty well with this. And 3 things to think about: trading ranges and downtrends, and then sort of a special case in the downtrend, which is the hidden upthrust. But so I guess I should have put in here another asterisk or a bullet and just said upthrusts and then hidden upthrusts. Well, let's talk a little bit more about these. So a trading range, this probably seems silly, but just so that we're pretty clear on this, at least from the way I consider a trading range, I need to see 3 points occur here before I can say that the trading range has started. So I need to see a resistance level here, a high, and then I need to see a reaction down, and then I need to see price come up and test over here and fail. We have a failure test. In other words, it's not going higher. It's not breaking out of this resistance, and then it turns down, comes back down again. So that's one key characteristic of a trading range. The other key characteristic to me of a trading range is that the wave structure, they're all about equal, these waves. Now I realize this one goes a little bit lower, and for those of you who understand this is a spring here, right? But for the most part, all these waves here are more or less, give or take, equal. Now, they're not going to be picture perfect like this when we look at real price charts, but if you can identify a trading range having taken place, and then we get an upthrust there, gee, I think that's a good trade. Let's take a look at a few. Here we have the Russell 2000 ETF, IWM. Nice example of a trading range where we put in this high here, and we get a reaction down, and we rally up, and we come back down, and notice that these waves, they're not identical, I realize that, but they're within the same order of magnitude here, right? We come up, and we get an upthrust now here at C, right? Here's the first one in this trading range. We come up, and we get weakness come in here, and then we get decisive weakness coming in on this price bar. I like to see this. Let's talk a little bit about this so that you're clear on this. I don't want anybody to be confused. Technically, this is an upthrust right here, okay? and I'll call this A, B, C, D, E, I'll call this F. At bar F, technically that's an upthrust. But it's not the weakest kind of an upthrust, right? What I like to see is price clearly get rejected up there. It does get rejected at F, but at C, there's no doubt in my mind that higher prices are rejected up here. Why? Because it tries to go up, and here it can't even get up above the high of F. Really what happens is sellers came in and supply swamped demand, and here we get a close on the low, and as sort of an added bonus, it gets closed below bar F, right? F is certainly weak because it rallies up and closes in the middle. I'm not saying that it's not weak, and I'm not saying it's not an upthrust, but C would be my preferred, and then I'd know that we've got something going on here, okay? So here we have a trading range and a nice trade to the bottom end of the trading range, down in here someplace. It springs over here. We get a rally up. Notice on the rally, we drop off in volume. We come up, and again, technically, I guess D would be one of those upthrust type things like F, but again, it doesn't sing a good song to me. It doesn't sing the decisive song of supply. E clearly does, and that's a nice trade for me, okay? Notice the bar after E here is a no demand, which you can look for as well. We get supply come in, then we get a weak rally coming up. Notice the volume going down. Supply comes in, volume increases, weak rally. You can hold that trade a little bit longer. We get more supply coming in, and then supply dries up down over here. So you could take it off over here somewhere. So you get a couple of nice trades out of this in a trading range, and that's what you would want to look for. It's a nice way to look for these. Here's another example. Here's QQQ on a daily. It's an upthrust of a bit of a trading range that's set up. Here it's probably not as clean a trading range as I'd like to see, because we do go a little bit lower here, but there is kind of weakness in the background. But you can see once again that we have a pretty good indication of weakness on this bar A here. We're not only closing underneath the level of resistance, but we're wiping out a couple of days worth of buying that went on on the bar before A and the bar before that. And we also get an increase in volume. So it means that sellers are really coming in and swamping demand. And you can trade that. Exits, you can trade, you know, if price gets rejected at the top of a trading range, it has a right really to go down to the bottom of the trading range. And so your target could be down here, down at this level. And truthfully, that's probably where I would look to take that off. It does go lower, but you wouldn't necessarily know that when you were trading it. And there's different ways to manage that. Here we go. We have a little bit of shortening of the thrust here. This is euro currency on a daily basis. We get a little shortening of the thrust here. Change in wave structure from the smaller down waves that we had seen earlier. We get that protracted. Look at how many months we're going across here, from May to mid-April to looks like around the end of July. And then we get that upthrust, and then it comes down. So if you can identify trading ranges like this, here's another one on with the Aussie dollar. And I put this one in on purpose. Here we've got a trading range. We have supply that's come in here, a weak rally coming up, but here it looks like it's going to hold, and it looks like it wants to try to hold above this supply and go higher. And certainly up here, you have to be thinking, my goodness, maybe this market's going to go higher. This looks like we're trying to absorb through here and then go higher. But look at how when we come down, volume increases, supply is present in here. And we come down pretty hard. In just a few days, we come back down to the bottom end of this, what some of us might have thought to be absorption here, and it came down pretty hard into that. So that also is a nice indication of weakness on a 60-minute Aussie dollar chart. Is that a tricky jump across the creek? Yeah, it's a failed jump across the creek. Yeah, you would think that it was going to go higher here. I certainly would if I were watching this. But I'd also be looking at this and saying, gee, it's coming. Look, if you're seeing this and you say, gee whiz, that's pretty impressive. But then you see this where it comes back down decisively like this. Then you want to go short in here. You want to look for a short because that's a good upthrust. It shouldn't do this. It should come down on narrow ranges, light volume, hold right around here, not decisively break this thing, and just kind of hang lower. That's a telltale sign that we've got a problem here. Okay, here we have IWM again. IWM is a good upthrust stock to watch. We see it happen all the time. We get a resistance level put in here, kind of a lackluster rally going up, kind of one of those grinding rallies coming up. Note that we get a big move down, and then a big, the move comes back up again, we come down, potential trading range. Look at what happens. We try to go up, and we don't. We close underneath. We're closing underneath all of the other highs here, too, from C and B. We're not holding up here. It's just suggesting more weakness coming in. And we can see that this is the result. This is that area of D here, and then we start to come down. And we break down through the bottom of that range and go lower. So another indication. All right, so that's trading ranges. If you can identify good trading ranges, it's a simple and straightforward way to think about trading an upthrust. Okay, you don't have to, you should still look for the weaknesses and changes in wave structure and all of that, but to make it a little more mechanical, if you will, or a little less, I don't want to say sophisticated, but I think you get the idea what I'm trying to say. A little simpler, you can do it with trading ranges. All right, upthrust in a downtrend. Conceptually, it looks something like this. We're in a good downtrend. We're making lower lows and lower highs. That's the definition of a good downtrend. And the wave structure is larger to the downside. Then we'll get this sideways movement. A rally occurs. This might be drawn so that the wave structure is a little bit small, but in any event, you get the idea. We get an upthrust occurring in a downtrend. And these are nice little trades. Here we are looking at the SPY, and that's the ETF for the S&P 500. It's an intraday chart. We've got this long sideways line. We talked about how long sideways lines build cause. They build an opportunity for either accumulation or distribution. And because we're talking about weakness, we're talking about distribution here. It breaks down through that, tries to rally back up, fails to do so, and a fairly decisive failure to do so, and goes lower. Okay, some volume comes in, buyers step in. We get a little bit of buying coming in here, and we get a rally, but this rally is not that great, and we put in a high. Now we're only on a 5-minute basis, so we don't need to be as thoughtful about having a big, large space or number of bars here, but we get more weakness here as we start to drop off. We rally up, not much. We get a little bit of a climactic action here on this bar as we come up. We wouldn't know it at the time. We would have to say, gee, it's got a chance to go higher. We would only know that it was climactic by the upthrust bar here on the very next bar. No more buying available because it's low volume, and it turns around and closes underneath the resistance and underneath the high of this big volume bar. So if all this was buying, then the next bar shouldn't do this. it's just showing weakness in there. And then here's the result of that. We drop down. Yeah, good point, Wesley. Excellent point. Nice spacing back to the green resistance line. Let's go back to that. Yeah, this is one of those things where we fall out of the ice, right? Remember we talked about that Boy Scout story? This is the fall through the ice. So he's walking along here, and the ice is pretty good. It's able to support him as he goes along, but here it doesn't. It gets too thin, and he falls right through. Now, a little bit later, he's now downstream, and he tries desperately to swim back up, but if we extended that line out, he comes back up to the edge of the ice, bumps his head against the ice. It's too thick to go through, and then he falls and drowns, and it gets macabre and tragic after that. I don't know. Evans also had the Shell Divers tragedy and a couple of others that were sort of bizarre little stories, but they're useful that way. But yeah, good observation. Good observation. And that's one of the things you want to look for, absolutely. Here's another example on a S&P 5-minute chart. Nice little upthrust in a declining market. We open the day here, we try to rally up, and we don't get very far. You can see the wave structure. Can you all see this? I mean, it looks pretty good. It looks like we want to try to go higher. We don't. We put in a lower high here, and then we put in a lower low over here. And the down wave gets larger, right? Bigger than anything we've seen so far. So there's only one thing that does that, and that's supply that comes into the market. You can see that, if you step back and soften your focus a little bit and not be riveted to the last bar or two on the edge of the chart, but start to look and see how the market's unfolding, then you can start to see this stuff. And we've got a downtrend, a bona fide downtrend with a lower low, good wave structure, and a lower high, right? There's no question we've got a good, sorry, I'm like a kid doing this because it's with a mouse. It's not the easiest to write this, but we got a lower high here, change in the wave structure, a lower low. So we get a good upthrust that occurs actually on this bar. I mislabeled this a little bit. Didn't give us much. Again, I'm not trying to show you, picture perfect stuff. I'm trying to show you real life stuff. Somebody asked about shortening of the thrust in the price bars. There it is, right there. We get shortening of the down thrust here. With good volume coming in, it's a clue that we're going to try to rally here. And you have to make a decision, trade management decision, whether you hang on to that trade or you pitch it out. We come up, we make another upthrust here. But notice, we still have a lower low being put in and a lower high. So you want to take these trades. And this trade turns out to be pretty nice. This one gives us 6 or 8 points, however many, which is nice in the S&Ps. So not all of these work out well, but when they do, they work out pretty good. And again, it's leaning on the background of the downtrend here. John says, what makes these upthrusts so powerful is you get traders trapped on the wrong side of the trade. Yeah, you do. It's true, John, you do. I don't think about that too much. I don't think about things like manipulation or traders being trapped or anything like that. Certainly I notice the flush when it occurs, and I notice that traders probably are trapped. But I'm looking at this and just saying that, gee, buyers tried to take it up here. Here's the way my mind would work about this, rather than think about who's trapped and all of that sort of thing. But it's not bad. I'm not saying not to do that, because if you think in those terms and you see, a lot of guys tried to, and women tried to go long in here and they got trapped, and now they're going to have to bail out, and that's going to force the market down further. If that's your thought process, I think that's great, and I wouldn't try to change that. What I think is this. Supply came in. Buyers tried to buy here, tried to take the market up. They failed. Supply came in and swamped. All we're doing is going sideways. There's very little buying going on here. Somebody tried to step in and buy. They got creamed. I'm going short. That's kind of the way I would be thinking about it, right? And I'd say, well, that trade didn't, maybe if I hung on to it, let's say even into here, I might say, gee, that trade really isn't doing very well. What's going on here? And now we're going through the whole noon hour. Now I've got from about, I don't know, a little after 11 till about 2 o'clock, say, 2:15. So that's, 3, 4 hour, 11, so 12, 1, 2, 3 hours of just going sideways after this. And we're underneath, let me erase this so you got it clear. We're underneath the morning low, and we're unable to get up above it. And I'd say, and we're coming in around 2:30, which I know in the S&Ps is a key time. We often see the afternoon trend start around then. So I'll be back in, even if this trade didn't work out all that great, I'll be back in here for sure and take that trade. Because again, I'm saying, there's just no buying going on, and every time they try to bring it up, sellers come in. So I'll go into that, and I'll go short. So that's kind of the way I think about it, rather than thinking about who's trapped and all of that. But really, if that works for you, then just stick with it. Here's another Upthrust example where this is a recent one in IWM. I said that this is a pretty good stock to watch for Upthrust, and it really is. And another good idea here is to watch this against the SPY and the Qs and the diamonds. And you'll just look at the I'll say, I won't go into this in great depth, but just look at these 4 markets at the turning points, and I'll leave you to look for those. You'll see non-confirmations all over the place. We have supply come in here. We have a lower low. We have change in the wave structure, right? Look at the waves are much larger to the downside here than they have been, all the way up. So this is, not going to go away very, very quickly. We come into a little bit of a trading range, and there we are, an upthrust. And it's a nice one, and it takes us down to the bottom end of that trading range before it tries to spring back up. So there's another pretty nice example. Here we are on a weekly basis. This is TWX on a weekly chart in a very nice downtrend. No change, nothing significant in the wave structure. We get into a little bit of a trading range, beautiful little upthrust, and it takes us down. Okay. You go into your charts and look for these. They're pretty obvious when they occur. You'll see them all the time and all over the place. Here we're still in a downtrend. I put this chart up on purpose because sometimes people think, gee, we're rallying here. Well, you have to really look at the chart, and I put a number of months up here, and make a lower low, a lower high from this high back here, certainly a lower low, right? I don't see a new high here. I still see a lower high. And I can draw a trend line, a reverse use of trend line across here. I can see that we're not coming up to that level at C. Instead, we're up thrusting. And also, we are in a supply area, a known supply area back here at A and this level here. And it's struggling to go up above that. So, and when the upthrust comes in, which is actually on this bar here, we're closing back down into this level. So it's a good spot to not necessarily go short, but looking at this is the Qs on a daily. So you can look to trade this intraday to the downside for a bit, okay? Or go short on Qs, that's okay too. But yeah, we're in a bit of a trading range. Well, yeah, we're in a trading range here. Yes, we are, definitely. Yeah, we are in a bit of a trading range here. Good observation, Erica. All right, hidden upthrust. I said this is another one. This is like a key, I call it a key reversal bar to the downside. Key reversal bars usually are thought of as an up bar, you might be coming down in a bit of a little reaction, and then the last bar tends to dip underneath and close on its high, and close usually well up into the previous bar or two. That's called a key reversal bar, okay, where we're coming down and then we reverse. So this is just the opposite. It's a key reversal to the bar to the upside. Here we're coming up, and we're coming up, and we get this higher high, but then we get a poor close. So it's this bar here, and it's just a key reversal to the downside. Okay. It's hidden because we're up thrusting resistance really on a lower time frame, a minor resistance, and it's more theoretical than it is. This is a Tom Williams concept, and it's one that I really like. It's more of a theoretical concept than an actual time frame concept. In other words, if we saw this on a 5-minute, we wouldn't see an upthrust necessarily on a 1-minute. It's just more of a theoretical thing. I like this in a downtrending market. And let's take a look at why. Here's a good conceptual map of it. We're in a downtrend, and we get sort of that straight, right in here, we get that weak rally, and this is the hidden upthrust right here, that key reversal bar that comes in right at the end or right at the top, and it's usually pretty good. It's usually a pretty nice trade in a downtrend. So this is a variation on an upthrust in a downtrend, the hidden upthrust. So here's some good examples of it. Here we have some weakness coming in, and the first A may not be a trade that you would say, okay, well, let's, we're coming down here. Maybe something that you don't want, you wouldn't want to place a trade on necessarily. But the second one is pretty nice. I think that, you're coming in, you're making lower lows and lower highs, and you get a hidden upthrust here. It's upthrusting whatever resistance is on this other time frame, this minor time frame, and it takes the market down a bit. Okay, we'll see some other examples. Here's another good one. This is a 3600 tick chart, one that I like to use a lot in the S&Ps. It's somewhere between a 10 and a 15-minute chart, depending on how active the market is. And we're in a good downtrend. We break down below yesterday's low. We try to rally up, and we get a nice key reversal or a hidden upthrust there. A lovely little trade on a downtrending market. Here's another pretty good example of one. Doesn't give us a lot on this leg down, not until the second leg, but you can see we're coming down. We're breaking down through this sideways line. Momentum starts to pick up, and we get a nice hidden upthrust there. Okay. And here's another example. And I would personally call this a hidden upthrust because there's not much space in between this resistance. You might term it differently. You might see it more as an upthrust, but we're coming into as a downtrend. We get kind of a weak rally here and a nice little hidden upthrust, and that takes us down. And this is a daily stock. American Eagle Outfitters. So you can just focus on those three things. Let me back up here a second. You can focus in on upthrusts of a trading range, a well-established trading range, upthrusts of a downtrend, and then the hidden upthrust is kind of like when the market's really moving down fairly swiftly and there's not much of a rally. You don't get that complicated rally. You get, these a simple little rally that doesn't give you much opportunity to enter, right? And this is one way to do it. You can enter on a hidden upthrust like that, or that key reversal. So, and you've got the trend or the trading range a sort of wind to your back. You don't have to make the odds are in your favor because you're really trading with the trend. All right, so when do up thrusts fail? So today in the SPY and Qs is an example of this, says John. An example of an upthrust? Oh, a hidden upthrust. No, I don't think so. Because we rallied up today and closed on the high, right? At least we did in the S&Ps. So we dipped underneath yesterday's low. Yeah, we dipped under yesterday's low. I'll just pull it up here for a second because I don't want you to be confused. Just bear with me a second and I'll pull my chart up. Here's the, oh, you said SPY. I'll put up SPY here. Here's SPY. So today we dipped underneath and rallied up. It's a key reverse. Well, I wouldn't call this a key reversal bar, but because it's not in the right location, but it's a reversal bar. And I would anticipate tomorrow, what I'd be watching for tomorrow is the high of yesterday and today. And I would look to see this market, try to push up above that. I mean, it's got a lot of resistance in here, so it may not get very far. There's resistance there, but I'd be looking to see what it would do. First task of tomorrow is to get up above these highs. And then the next task would be to get up above this level if we were looking for it to rally back up again. We're in a pretty good downtrend here. So we have to, see what the story is and how this unfolds. And we're really, are we going to go back down and test underneath that 101 level here in SPY? That's the key question. And, we're coming through this trend channel here, this trading channel. We're coming into where we would expect demand to come in. We're coming along to the demand line. But the question is, can it get much above 108? Is it going to come up into here, fail, and then come back down again? We don't know. No one knows. But those are the key considerations to make. So we don't really have a hidden upthrust here. And I don't really even see one on this chart so far. You could maybe consider this to be a hidden upthrust in here as one. And remember, I showed you IWM where we had an upthrust. It upthrusted this, and I suggested take a look at SPY and IWM together. And so you've got a hidden upthrust here and an upthrust on SPY. But right in here, I wouldn't, it's potentially a reversal to the upside, but we're not really seeing that there. Okay, so when upthrusts fail in an uptrend, right? They're terrible in an uptrend, and I wouldn't try to trade them. It's one of the things that I see traders do. When I was doing the VSA club, people would say, "But it's an upthrust. It's an upthrust. You should short it." But but we're in a good, strong trend going up. So it wasn't, it's just try not to focus only on the right edge of the chart. You want to look at the whole background. We've spent, much less time on the upthrust itself and much more time on the background. So, and looking at weakness and how to identify that on these upthrusts. So kind of think about that. Why would I be doing that? Well, it's because that's where the real analysis is. It's not on the upthrust itself. It's in the background conditions, the wave structure and the selling that comes in and all of that stuff. All right, significant strength in the background is also something that will cause an upthrust to fail, and then something called absorption. All right, so look at this. Here's a nice upthrust, but we're in an uptrend, right? We're making higher highs here, higher high, higher low. Have we seen the wave structure changed? I sure haven't. Higher high, higher low. Look at this. The waves are high, large to the upside, small to the down. Large to the upside, small to the down. Large to the upside, small to the down. We're making another higher high up in here and a higher low. And yet it looks like an upthrust, right? And you can say, well, there's heavy volume here and volume comes in, supply on an up arm, blah, 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 and light volume here. Well, let's take a look at this chart and just see what happens. And that's where we were, right there on the edge of this chart. I'll go back. This is where we are here, and that's where we are here. Yeah, it takes the market down a little bit, but look at what happens. It continues to go up. Please, if nothing else, if you get nothing else out of this, please do not try to trade short these so-called upthrusts, these upthrust type bars. Do not try to trade them short in an uptrend, because you will just get your head handed to you. It's like stepping in front of a freight train. What I believe is going on is just absorption here. In other words, as the market rallies up, and yeah, look at all the volume coming in here. As the market's rallying up, we see some weakness. We see some supply. Some supply exists. But it just gets absorbed and the market goes higher because we're in an uptrend, right? If we were coming down and we saw these bars, we'd want to short almost every one of them, for goodness sakes. But that's when we're in a downtrend. Here we're in an uptrend. So you commit suicide to trade the upthrust in an uptrend, right? Well, that's one way to think about it. I'm not quite sure I would say suicide. That's a little dramatic, but it certainly would be suicide for your account. That I will say. This is going low, no supply. Yeah, see, it's easy to get confused with this, right? It's easy to get confused with these because I know that some people think that an upthrust is just a bar, but it's more than a bar. Go back, you know, when you're reviewing this tape, go back to the very first conceptual map that I gave you of an upthrust. It has to have that resistance right here, right? And I said there needs to be decent space. You know, we've looked at stuff that's gone for months. We've also looked for stuff that's gone shorter than that, for sure. But there has to be some decent space. 2 or 3 bars here, 2 or 3 bars here is not decent space. We've also talked about if we're going to trade these, we want to see some change in the wave structure, right? We don't see that even if you say, well, this has got more space to it, right? But we don't see a change in the wave structure, okay? We don't see weakness. What we see is strength in this market. It's not a great trending market. It's kind of one of those grinding markets on low volume, going up, right? The volume's low, the market keeps going up. It's one of those low volatility, grinding up move markets. And you'll see these upthrust looking bars all the time, but they're not true upthrusts, at least the way Wyckoff folks think about it, okay? Yeah, Erica says it works very well after a trading range is formed and comes in at the right side of the chart, right? Yeah, exactly. That's the point of that. When I suggested looking at this in a more simplified manner, just looking for downtrends and trading ranges, and you take the upthrust in the trading range, and in the downtrend you can take the upthrust or the hidden upthrust, that key reversal. That's going to keep you out of trouble most of the time, okay? And it does work quite well. Those are where you're going to see your highest odds trades in an upthrust. And then if you can piece together all that weakness that we've been talking about, if you can piece that background stuff together, then yeah, the more classic ones work really well too. Okay, a nice spring on 328. Yep, it is a good one right there. Very nice observation, Janet. Just no demand bars in an uptrend. Yeah, I guess you could say that. Lars makes a good point. He says, wait for the break of a trend line and then retest that line. And exactly right. You want to see an uptrend broken before you see, and we didn't really talk about that. Lars, that's actually an excellent point. You know, when we're looking at, sometimes we'll see this, uptrend going on like this, and that would be our trend line, our demand line, but here it gets broken right here, right? And then if it comes back up and tries to test this, or it's actually testing the resistance, and then it upthrusts that, then that could be a good place to go short too. I didn't talk too much about trend lines tonight because I didn't want to get into that, but it's a very good observation, Lars, is that you can add that piece to this where we see, we've talked about supply coming in at resistance. We've talked about change in the wave structure. We've talked about weak rally. We've talked about, narrow bars or high volume or low volume up here. And you can add the break of the trend line coming up, the demand line coming up. Very good. You just need to make sure there's supply weakness in the background. Yeah, John, I agree that you want to always do that. And we need, yes, Erica makes a good point. Here, where this is so small, these little, I wouldn't call these trading ranges, but these little, so few bars here, there's no cause. Remember we talked about the long sideways line will tend to churn the market because it's typically some kind of distribution or some kind of accumulation if it happens on the bottom, and distribution if it's happening closer to the top, some sort of pattern like that. Here you don't have any sideways line to do that, so no cause can be built. That's right. Double tops and M patterns. Yeah, we don't see those as cleanly anymore like we used to. It's, the double top patterns, the M's and the W's are not as, I think people kind of saw those and traded them, and we don't see them as much anymore. Here we come up and we have some bit of resistance, and you could say, oh, gee, there's a nice 1, 2, 3 pattern. There's a shortening of the thrust. It kind of rolls over. We get some big supply comes in here, right? And absolutely, and then the wave structure changes. It's certainly bigger than any of these coming down, right? Or any of these coming down as we go up. So we could be saying to ourselves, now several weeks or months actually later, the market's rallying up, and we can be saying, okay, let's be looking for an upthrust here. And we could. And we see one that comes in here, or maybe we wait over until here, and that's fine. We might even take that trade. But then what happens? The market just goes sideways, and it's holding its gains here. It's not giving up anything, okay? And also, we could also be saying that the wave structure has changed back up again because the larger, the up waves are larger than the down waves. But the key thing I want to say about here is this is killer. This is a killer for an upthrust, and that is what we call absorption. And it's just holding gains, just kind of resting up here and not giving up any ground at this point. So if you get into an upthrust and the market just goes sideways on you and doesn't go lower, it doesn't give you even a good reaction, then that's an indication you don't want to be short, that we're probably in an absorption, and we're likely to see some higher prices. when strength comes into the market, Erica, this is actually a chart you sent me of ARNA on a daily basis. And look at what happens here. You sent me the daily. This is the weekly. So here we are in some sort of a downtrend here, and we come down, and look at what happens here. We have a higher high, first one, right? And we break the downtrend, and we do so on a nice move up here. This is a small cap stock, so we're going to see volatility, and we see it certainly here. We come down. We don't make a new low. Well, we do, I'm sorry. We make a new low, but we don't come down all the way to the bottom of the trend channel, and we go into a trading range. And remember, look at the length of time between, well, even from this low here, compared to every other rally that we have, or every other reaction, and we're going sideways. And now look at what happens here. I put this green arrow. Look at the bars move up, and look at the volume expand. That's strength, right? So this is an instance where we don't want to be. Remember, when we were looking at early in the chart, we saw the market really falling like a knife down through the bottom end of the trading range, and we said that it's going to go lower because of that. Well, here's just the opposite. Now we're punching up through the top of the trading range. And so now the odds favor. We don't know if this is going to go higher, but the odds favor that this market can go higher. We've got strength here, and if we were to look at this on a daily chart, there would be 5 days for every bar here. We're just going sideways, and we're potentially just absorbing in here. We're just potentially absorbing whatever residual supply remains from this area over here. So this is strength. This is where we don't want to be taking a short trade, okay? Consolidation pattern is bullish too. Yeah, John, it can be, certainly in the right place. No question. But we're talking really weakness here tonight, so I'm highlighting that. It's not. I don't mean to say that every consolidation pattern that goes, a long sideways line is going to give us weakness. You're absolutely right. It can be bullish. So please, everybody, don't misread what I'm saying. What we're emphasizing is a short side trade, so I'm emphasizing the weakness, and that's good, John, that you pointed that out. Thanks for doing that. Yeah, there's a good, and John, I'm sorry, I didn't catch that failure to move away from the danger zone right away. Let's just go back up to that chart. That's an excellent point, because you're absolutely right. Here we want to see this market move and move fast. The best trades occur quickly. They start to reward us pretty soon. So when it's, we don't want to see the market rally back. Here's the danger point. It's the top of our upthrust level here, or the top of the resistance level. We don't want to see the market. We want to see the market react away from this and start to fall away from the danger zone, which is up in here, the danger point, what Wyckoff called the danger point. But here, it's not doing that. It's just hanging here. So the odds start to increase that it's going to go up through our danger point. We don't want that. Excellent point, John. Thanks for raising that. And here's the same thing. We're kind of holding those gains. That's what absorption is all about, and some strength in the marketplace. Here's one that may not be so obvious for folks, but here we've got strength in the background. And I don't know if you can see this or not, but if we look at this, we've got this kind of long line here, and we break to the upside, right? And then we come back here, and we've got this line here, and what do? We break to the upside, right? So this is, in fact, John, it was almost like we planned this, but we didn't, because well, we just didn't. But consolidation patterns can be bullish too, and here's one where it is. What we have in this pattern is we have nice movement to the upside, and we have this fairly long consolidation with a couple of springs that occur here, the last one being a good one. Or you can consider it, if you want, if you were more of a Shabak kind of guy or woman, you would call this a very long flag. formation or a rectangle formation or whatever you want to call it. But in any event, it's a consolidation pattern, but it doesn't ever really go very low. It has a series of lower highs and lower lows, but they're pretty well contained and pretty well behaved. So this consolidation pattern, John's exactly right. This is very bullish. It gives a chance for buying to take place. And you can see that in the high volume every time it dips down to the lows. Not every single time. And there is a little bit of supply at the top, but for the most part, when it comes down into these lows, there's buying opportunity for buyers. We come up, we absorb in here. Notice how it goes sideways. We're absorbing whatever residual supply exists over here, and then we rally up. So now there's strength in the background. It's not the place to go short here. It just isn't. I would look at this and say, no way, Jose. Just wouldn't happen. And so I highlighted this here, and you can see what happens with this strength in the background. Just the market comes in and consolidates on top of this, and it doesn't break down below that. It's testing this. We absorb supply in here, a little bit of absorption here because we talked about supply, and you can see it in the high volume. And now it comes back and it tests it over here. Markets do this all the time. This is not the place to be going short in here or here on these up thrusts. Same thing here. We make higher highs. Yeah, we get a little bit of a shakeout or a little bit of a swift move down. That's not enough to give us this idea of we can go short. It's just not. And we, if you made, let's say you did go short in here somewhere, in any of these areas here, any of these so-called up thrusts. It just, when it goes sideways for several bars like this or like this, it's just saying that it's absorbing, and you want to get out of that. You don't want to stay in. And most of the time, by the way, these up thrusts, if you do make a mistake like that, and so long as you can recognize it fairly soon, it is fairly forgiving. It gives you an opportunity in most cases like this. Here it kind of did, depending on where you might have shorted. If you did short in here, kind of was forgiving. But your emotional meter should be going off and reading red in terms of, am I going to get nailed on this trade? And if that's going on, and it's going sideways, then you want to get out of that trade because this thing should fall right off. Okay. Erica was talking about that. Yeah, good for you, Erica. That's good. Isn't this a solid up thrust? I asked this question, right, in sort of a backhand manner. You probably will see that it's not by the way that I answer the question. So let's just go through this chart a little bit. Whoops. Well, I'll go back to that. Here we're in a good downtrend, right? So you have to be a little bit careful of this stuff too. Just because we're in a downtrend doesn't necessarily mean that we want to take every single one. We need to know how to read trends a little bit too. And for those of you who've worked with me, you'll see this pretty quickly. We're coming down and we're in a nice downtrend, and then we start to accelerate that. And then I didn't draw this in. I wasn't going to talk too much about that, but we accelerate even more. And if we were to have drawn this as a parallel, we're getting shortening of the thrust in here and stuff. And that's maybe a little bit more advanced than I want to go into, but we're actually getting climactic action in here a little bit because of the steepness that we're seeing in the trend line. But we're also getting that 3 pushes down, 1, 2, 3, I got them labeled here, and we have buying coming in on these volumes and these bars here. Large buying is coming in. You have to be cautious about this. We see the largest volume on this chart and the largest up bar on this downtrend occurring here at 1, and the second largest volume, or almost the second largest volume on this chart since the downtrend began, I should say, comes in at 2, and it's also on an up bar. And then we get these minor little range bars here and still very heavy volume coming in. That has to caution you that we're coming into, that we've either had a little bit of a climax or that we're coming into a lot of buying here. It may turn, it may rally up a little bit and then falter down. But what happens? On this rally, we break the downtrend line here at 4, don't we? And we also see, as we rally up, we see volume coming into the upside. So here's an instance where we've got a downtrend going on, but strength is coming in the background. And we have an upthrust here. It does give us a little bit. Typically on when we're in a good downtrend, it takes a while for a downtrend, any trend, up or down. It takes a while for it to change. So as I said before, it can be forgiving. You would expect this market to come down and begin to make a new leg down. And when you start to see certainly this here, especially on high volume like this, you want to scratch your trade out or get out of your trade if you did take an upthrust in here. Okay. But that's just another indication of strength coming into the market. Let's see. Okay, a bunch of questions here. Would I not consider September 1 as a potential buying climax? Which chart are we talking about, Daphne? Are we on? Back to this one. Oh, September 1 as a selling climax, buying climax? Not necessarily, because we're breaking up through the resistance level, and then we're holding gains pretty well after that. So no, not necessarily. And we've got all of this buying in the background. I'd be a little concerned by this because it's a we don't see that before, although it's not much larger than any of these, so it's not a huge concern. But no, I wouldn't see that way. Regarding the range before the upthrust, I often see that the high closing price is of more importance than the actual extreme high. Could I use this close as resistance criteria, or are you strict about the extreme high for calling it upthrust? Lars is saying that when he looks at a range, sometimes he looks at the high close rather than the high. An upthrust is thrusting up above the high of the previous resistance. So you would have to, you might have a trade there, Lars, that works well off of the close. And if you do, and you've done enough of your own research on it or traded it well enough that you know that it's good, I'd stick with it. I wouldn't tell you to change that. But in terms of upthrust itself, we're looking at the high of the resistance. There's no real top in the background of that chart. Yep, that's right, Alan. That's the chart before here. There is no real top here. That's right. We're just continuing to grind our way up. Good to see you, Alan, by the way. I keep meaning to write you an email, and I keep not doing it because I've got so many other things, so I apologize for that. I'm ready this time for your trick. There is demand coming in and volume previous to the upthrust. Scott. Oh, yeah, you mean on this chart here, the demand is coming in previous to the upthrust? I'm not sure exactly. Yeah, right. Yeah, I mean, it's not really a trick per se. It's just knowing that this is occurring here. You still might take this trade. You still might say, well, we're in a downtrend and we really haven't, I mean, there's enough strength coming in. It would make you cautious, but you could still say, okay, I'm going to try it anyway. And it's not a bad, you do get down below here, but look, whoops, when it comes down, certainly, when it comes down and springs here, that's telling you clearly that something's wrong in this. When you have an upthrust, it should come down. There should be no spring after that. It should come. Spring, by the way, folks, is kind of the opposite of an upthrust. For those of you who don't know, where trading ranges established and you get support and it comes underneath that support and then bounces off of it. It's kind of the opposite of an upthrust. So you don't want to see that once you're in an upthrust. So even if you got in on the trade here, if this is pretty careful reading of this. Not to say that you wouldn't carefully read it, but you could easily miss this strength coming into, I don't know. I mean, the more experience you have, you see something like this on this kind of volume, you know that there's something going on here, and that you don't want to be, you want to be cautious, and you want the market to sort itself out before you start making trades. But you still might, take a trade like that. So if you do, it's trade management. You want to read this, and a spring is a sign of strength, and that's something you don't want to have happen in your short trade on an upthrust. Let's see, that is preliminary support. Yeah, kind of. It is. It's preliminary support, and then you got climactic action in here. That's right, Erica. Good. Back on COP. Back on COP. Oh, back on COP. Let's see if, okay, here we go. Back on COP, and I got to go back. Would you not consider September 1 as a potential buying climax? Yeah, okay, we talked about that, I think. Yep. All right, good. Yep. I think I have your sell. Yeah, we can talk after the market. I'm tied up the next couple of weeks, though. So after the 1st of September, Alan is okay. So okay, sorry, I didn't have to say that for everybody else to hear. Okay, entry considerations. You can take it on the upthrust. You can take it on a test of the upthrust, or what VSA calls no demand. You can also wait for a hidden upthrust. It may or may not occur. I should have put that in. I didn't put it in as a hidden upthrust because they don't always occur. The problem with a good upthrust is it goes. It starts to fall right away. But you can, you play with this and see what you're most comfortable with, okay? Exit considerations. Boy, it's so hard to do this. It's always going to be a personal consideration. You can trail a stop and do well with this. You can look for higher time frame resistance and take your trade off at that point. You can scale out, something I advocate a lot. So, for example, you get in on an upthrust here, and you might take the first piece off. Let's say you're going to trade a scale out of 3, 1/3, 1/3, 1/3. So you take 1/3 off at the first level of resistance. You take the next level off at a higher time frame resistance. And the third you might take off as a trailing stop, okay? That's a way to do it. I mean, there's so many different ways to do this, but I think that scaling out is not a bad idea. I do it all the time, and I also use higher time frame resistance. I rarely trail a stop. I kind of mentally trail stops, but that's my personal trading, and it's totally up to you for what you like. I mean, Wilder's SAR parabolic stop system is a really good system. If you want to look at something good like that, that's one to think about. An indicator value. You might have an RSI value that you get in, and so you're looking for a low RSI value to exit out on. That's something, or some other kind of indicator value. Those are valid. A fixed profit of, I'll take 4 points in the S&Ps if I get it. You can do that. I'm less sanguine about that one, but some people do that. You can scale out with a fixed profit. You can say, okay, if I'm trading the S&Ps, or if I'm trading FX, I'm going to take the first profit off. First, I'm going to scale out on the first 25 or 30 pips, and then I'm going to hold the next and see if I can't get down to the next higher time frame resistance. There's all kinds of ways to do this. Certainly on a sign of, that shouldn't say weakness, it should say strength. I apologize for that. I was thinking weakness. Like we just talked about, a spring coming in, that's a sign of strength. The market responds to that spring. GHT, right? I think that's spelled right. It doesn't look right because I'm like a kid in school writing it, so it looks wrong just because of that. But so we just talked about that. When a sign of strength comes in, you want to think about getting out. A time stop. If it doesn't move in your direction within X number of bars, you might want to consider getting yourself out. That's an exit. Scratching a trade, that's an exit. That's a valid exit too, when it's unable to fall from the danger point, as John was saying before. When it's going sideways and we see that absorption, right, that potential for absorption, then you want to scratch the trade. There's no shame in scratching trades. You don't have to hold them to your intended target. They're all exit considerations. And there's more too, I'm sure, people would come up with. These are some of the common ones, some of the better ones. And I kind of indicated what's, I'm not big on fixed profits. I'm pretty big on scale outs and higher time frame resistance. That's shouldn't say resistance. I apologize for that. That should say support. You get yourself in a mindset of weakness, and that's what you're looking for. I'm looking to short against resistance. Okay, sorry about that. All right. So those are some exit considerations. So here's an example of entry on a test or a no demand, what VSA would call a no demand. You can see we get that nice up thrust, and sometimes this will occur here. You get a test-like bar or a no demand, that narrow range bar closing. It doesn't really matter where it closes, but it needs to be up above, the close needs to be higher than the previous bar, and then low volume. And the rule of thumb is volume less than the previous two bars. Okay. Notice then you get a hidden up thrust that follows right after that, so you can take it there. You get another hidden up thrust here. Okay, those key reversal bars that you can trade. They're pretty nice. Do they always work out? No, of course not. But this is a nice one here. Okay. Here's another no demand. I marked this on bar 4. This is on an S&P 5-minute chart, just to give you an example. We get that nice up thrust. We saw this chart earlier. I think I pointed this out, that we get that nice hidden up thrust here. For those of you who have worked with me, you know that this is another kind of nice effort versus result. We got a movement coming up here. We expect it to go higher, and then the very next bar or two goes underneath and closes poorly. And that's also a nice place to go short, and look at the kind of move you get from that. So you can piece that sort of stuff together. You don't have to just focus in only on, you can only on no demands and hidden up thrusts. You can also, you can look at the up thrust as a higher time frame and then drop to a smaller time frame, looking for a better trade opportunity there on the smaller time frame. So, for example, if you are trading the S&Ps on a 5-minute basis and you have an up thrust on the hourly chart, well, you look for momentum to come into the downside on the 5-minute and then a weak rally. Okay, and you take a 5-minute weak rally. So you can do it that way as well. All right, let's look at trade setup criteria quickly, because we're kind of going over time, as I am often want to do. This is the way I spec out my trade setups. I look at the market and time frames, and so here, for example, it's traded on the S&P and Russell E-minis on a 5 and a 15-minute basis, or 5 and 15-minute charts. Look at the S&P 100 stocks on a daily basis. Look at the NASDAQ 100 stocks on a daily basis. Here's one people might not be too familiar with, but the value line T5s. And this is the worst performing stocks of the value line universe. There are about 100 of them usually in this list. So those are very weak stocks. So you can kind of look as a fundamental filter, if you will. Their price earnings ratios, their sales ratios, their market share, all that sort of stuff gets factored in, and Value Line ranks them, and then these are the worst of the stocks that they track. And so they're often good candidates for this. So when to avoid them? I think it's also important when you're thinking about specifying your trade setup criteria, when to avoid them. We haven't talked about near economic news. We actually showed how you could use them near economic news, the FOMC, but you might not want to trade these near economic news. Certainly in a strong uptrend. In dull, flat markets where there's no oscillations, there's no volatility, you don't want to be trading these, okay? Because you're not going to get anything out of it. It may look like an upthrust, it may, quack like a duck, but is it really a duck? If it's a dull, flat market, it's probably a chicken or something else. It's not going to be a real upthrust. We talked about recent indications of strength as a time when we want to avoid upthrusts. We haven't talked about this, but if we're not able to set an adequate protective stop, and we're going to talk a little bit about this in a second when we talk about protection. So we'll come back to this, but if we can't take it, we pass on the trade, or maybe you use a smaller position size, or look to find an alternate entry, maybe than the upthrust bar itself. Background conditions. We spent a lot of time on this. Here's a little summary of this. Market's got to be active. It can't be dull and flat. A good one is an established trading range. Another good one is an established downtrend, or recent weakness comes in. We've seen a few examples of that. We've talked about wave structure and selling coming in. A power sell, which we're going to talk about in a minute. So we'll come back to this, but this is another nice way to trade this upthrust. Weakness in wave structure, we talked a little bit about that tonight. And then also obvious resistance. I'll show you some more obvious resistance before we conclude tonight with some charts. And we certainly want to see no follow through to the upside. In other words, price gets rejected, and it can be on either heavy or light volume, but price gets rejected up there. That's the condition. These are the conditions we're looking for. And then the setup criteria: price rallies up above resistance and the higher prices get rejected. Price falls and closes underneath that resistance level. That's a key thing. Okay, it has to do this. Entry is going to be a personal determination. You can be aggressive and do it on the upthrust, or you can be more conservative and do it on a test of the upthrust, or a no demand, or a hidden upthrust, or drop to a smaller time frame and look for an alternate short trade. Okay. Protection, I usually place it at or just above the high of the upthrust. You want to place your protection. This is more trading than it is more money management than anything, but it's part of this trade setup. I think it's part of the trade setup criteria that you got to piece into every trade you make. And again, it's going to be your personal way of doing it, but one way to do it is to base it on account size and not take more risk than, say, some percent of your current account size. A good rule of thumb is to keep between 1% and 3% of your account. I know that IBD advocates 7 to 10% when it's taking trades, which are only, I think, to the long side. To me, that if I lost 10% on a given trade, I would be horror struck. I couldn't do that. I like to keep mine closer to the 1 to 2% level. But that, again, it's a personal decision. All I'm trying to do is encourage you to think about, when you set a stop, manage, this is a question of money management, so think about that, where you want to place that stop. And if you can't place the stop to give yourself adequate protection, you either pass on the trade or you look for an alternate entry. You don't take the aggressive trade on the upthrust itself. And that may mean you miss a nice move. That happens. But there's another trade coming right around the corner. There always is. So you just let it go and don't worry about it, because it doesn't meet your trading plan. You should also have a profit target, and you should be fairly consistent with this. And again, it's a personal determination or decision. We've talked about the different ways of doing it, from trailing stops to using higher time frame resistance to an indicator value. Certainly if you see a sign of strength, get yourself out of the trade. That should be in everybody's trading plan for this. And it can be fixed time or profit. Fixed time meaning that you take the trade off of the first, I don't know, positive close or something. Maybe on a weekly basis rather than a daily basis if you're trading off of the daily chart. But that's what I mean by that. And then trade management. Again, it's going to be how you do things. You can scale out. If there's a failure to react, we've talked about the absorption problem in upthrust, you really do want to get out. You can set a time stop to make it more mechanical for you if there's a absorption problem that occurs. You know, it's a problem for the trade. It's not necessarily a problem, but it's problematic for the trade. So you might say, if it doesn't move in my direction within, you know, so many number of bars, and you have to do a little research on this if you want to use a time stop, then you can do that. Again, sudden strength, or there may be other considerations there too that would get you out of the trade that are good sound trade. Did I put resistance in there where I should have put support? I apologize, but I think you guys know if I did that. Thanks, Wesley, for pointing that out. I just made that, you know, my mind gets kind of focused in on one thing, and it just gets focused in on one thing. So I apologize for that. Okay, some additional tips before we close up here. Always remember, and I put this in red and in bold, because this is always the first consideration. Don't just look at the hard right edge of the chart and look at this and say, oh, I got an upthrust bar, let's go short. Your eyes need to go back to the left side of the chart and start reading this background. That's the key. And you want to be looking for weakness, and we talked a number of different ways to do that tonight, and you want to really look for downtrends. I mean, that's the simple way to do this. I want to talk a little bit about power cells here. I want to talk about leaning against resistance, and then I want to talk to you about a couple of ways of using higher time frames that crop up a lot in at least my trading, and I just wanted to point some of these out for you. We didn't really have time. That's more talking about structure of the market and how to use structure to your advantage. But I feel like I would be remiss if I didn't talk at least a little bit about it tonight before we leave. So I definitely want to get to that. And I got a couple of examples to talk about. Okay. So again, just reading the weakness, you know, we see the upthrust here coming in, and certainly there's definitely weakness coming in here on bar 2. Look at, we get this thing just starts to crash. But gee, there's weakness all over the place here. Look at the way, first of all, look at the long sideways line that we've got going on here for months and months, right? From October of one year to April of this year, okay? We're just going sideways. Look at the shortening of the thrust that occurs here. We get a little bit of a push in the wave structure. We certainly get a lower low down here. Wave structure to me looks like it's changed. Look at the weak rally going up. You see, if you start to look at this, if you start to really pay attention to the chart and start to take it apart, you can begin to see what's going on in the chart. You can begin to see the structure of the market. And as we came down in here, volume increased. Only supply does that. That's not demand coming in there. You know, if demand was overcoming, then we would see this kind of volume here over here as we rally up. But we don't. We see supply, ease of movement, acceleration to the downside, and just a weak rally coming up. So we get this upthrust, okay? And you can, might be a little bit hard to take the upthrust actually comes in at 2 here because we have to close below resistance, right? We do get that narrow range at 1, so that's a clue. But we certainly don't. But we don't really get the full confirmation until bar number 2, and that may be too large. You know, 4 or 5 points here might be too much of a stop to take. So we might drop down to a smaller time frame, or we might take this hidden up thrust at 3, or this no demand here and place the stop somewhere up above, make it more palatable because it's more confirmation coming in. But clearly weakness coming in on this chart. Now, notice the date here. This is April 14th, 2010, and I want to just point something out to you. That sometimes it's really hard to take these trades if we're reading the news or paying attention to what all the talking heads and the bobbleheads really on whatever those, I don't even know what they're called, CNBC or whatever. All those folks talking and talking and talking and trying to make heads or tails out of the markets, and they're not. Here, this is the news that occurred on April 14th, 2010. And let me just go back just one more time. This is JP Morgan on a daily basis, and here we are right here at April 14th, 2010 this year. This is the day, says the Wall Street Journal, the day the banks turn the corner, right? JP Morgan posts 55% surge in quarterly profit. Surprisingly, confident consumers and small business owners propel JP Morgan up to a 55% surge in profit, increasing optimism among investors that the U.S. banks are rebounding, right, from the crisis that staggered. Even Chief Executive Jamie Dimon expresses hope that the worst is over, right? We get a 3.3, here we are in CNN money, 3.3 billion. Profit at JP Morgan jumps 55%. Easily topping what investors were anticipating. It's not only big-time bullish news here. Look at what happens. Reuters is reporting that Europe is boosted by JP Morgan, right? Banks gain after JP Morgan. It powers the first quarter profit rise and so on and so forth. If this were all true, why does JP Morgan fall more than 10 points right after that? Okay? Now, I'm not saying that the markets are manipulated here. What I'm saying is, right up here, stay with the technicals, right? Don't try to figure things out here. Here you got a beautiful upthrust with all kinds of weakness in the background. If you were reading the newspapers and looking at all the news coming out from Reuters and the Wall Street Journal, the Reuters and Wall Street Journal, these are the titans of the news in Wall Street, right? How come the banks didn't really turn the corner then? Well, because there was supply, and the supply is seen in the upthrust. So that's just a caution, not to suggest that somebody was in there trying to manipulate. I don't think necessarily that was the case. I just read the supply that's going on in the markets, and so just watch the news. That's all I'm trying to say. It's going to make it harder for you than easier. Okay, so let's look at a power cell. Here's a conceptual map of the power cell. We're in a downtrend. This is a really nice trade, by the way. We're in a downtrend. And we get an ABC wave up. It's an Elliott type wave. But a three-wave pattern is it's a weak pattern. It's not what Elliott had motive and what was the other? Impulse and reactive, I guess, or consolidating patterns. I forget which. But this is not a trending pattern. That's another way to think about it, I guess. Yeah, impulse and corrective. Thank you, John. So a three-wave pattern here is a corrective pattern, and that's what a power cell is, because it suggests that we're going to see a new leg down in the direction of the prevailing trend. We see power buys as well, but this is power sell. So here we are. Here's an example of it on a NASDAQ stock. Notice that we're in a downtrend of some sort. We've broken down here through a low. Look at how beautiful this is. We get this nice ABC corrective pattern, and then we get an upthrust that occurs, and we get a nice new leg down. Okay? That's a really nice trade to look for. Here's one in a nice downtrend. We get an ABC correction where I just drew a trend line into the downside. It starts to pay off pretty immediately and takes it down another 10 points here on eBay. Here's another one, kind of an oddball one, because I saw this after I put the chart up and I didn't get a chance to change, but this was in a downtrend. And we make a lower low, and this is a lower high. And then we get this ABC correction here and an upthrust that occurs, and then that takes the market down. So this was a less clean example, but it was still a good example nevertheless, and I wanted to show it to you. But this was Goldman. You can go back to this. This is a few years ago, back 2000, I think. They had a higher high in there. You can also see hidden upthrusts on power cells, and those are pretty nice too. Here we have a downtrend, and we're making lower lows and lower highs, lower low. We get this ABC correction, and we get a hidden upthrust here, not a real true upthrust, but we're upthrusting some smaller time frame. We drop down, we get another ABC. This doesn't pay as much, it didn't result as much, but we get a small upthrust that occurs here as well. So watch for these. You can draw trend lines on them. You can do other kinds of things with them, but they're a very nice pattern to see. Elliott was onto something when he saw this, but we have to have that downtrend in place first, okay? Obvious resistance, okay? Here the market tries to go up once, and we get a little bit of, this is probably climactic action here. We go up, try to come up, we come down. We test it again here at 2. It tries to rally up again at 3. Then we go up, and we upthrust 2, and we do so on weak volume on the rally here. So when resistance is this obvious, when it's tried to go up at a few times, that's a nice time to take, I mean, we're in a trading range really, right? But it's a nice time to to look for an upthrust trade. Here's another example, just a different variation. We have resistance here. This is Google on a weekly basis. We get an upthrust, right? But and the market starts to come down, and then it rallies up a little bit. And if you were looking at this on a daily basis, you would see this A, B, C corrective power cell pattern occur, and then we get a so hidden upthrust, right, on the weekly chart here at A, but on the daily, if we looked, we would have this ABC corrective, and it's most likely to be a true upthrust there on the daily chart. So another way, when we see resistance and the market fails here, and then we see something that occurs that we can then look to trade. So the point being then is that we use the upthrust here as our background to give us a trade in here. It's another way to use resistance, okay? This happens on the S&Ps all the time, probably at least once or twice a week, either to the upside or the downside, where we're either springing off of a daily low or we're upthrusting some daily high. And here, since we're talking about weakness, I mean, think about it. If that's happening a couple of times a week, that's, you got a nice, if you're trading the S&Ps, this is something to really watch for. So here we are. This is a 5-minute chart, but here's yesterday's high. Now, we're rallying up, and it looks like, gee whiz, if we're not paying attention to this, or if we have all the overnight data in there, and it confounds everything for us, right? This is looking at this is a day session chart only here, right? And that's important to do if you're trading intraday. It's because you really want to kind of pull apart the daily highs and lows. And you can see that we upthrust this, and we get a nice move off of that upthrust. And that's something you can look for, because they'll often be sharp, and they'll be quick, and they'll frequently occur around 10 o'clock in the morning. Not always, but frequently. All right. Here's an upthrust here. that occurred a couple of days ago in the S&Ps on a 15-minute chart, and it was a nice upthrust. Now, this is a good example of piecing together background through using a higher time frame chart, and then looking for the trading opportunities on a shorter time frame, the 15-minute chart. So this is our 15-minute, and one higher time frame might be a 60-minute to look at. And so if we look at the 60-minute chart here, notice that we're in a sideways line here, and we've, of several days. Each of these little things here, that's a day's worth of trading. So we've got more than a week of trading in here. Now we could even probably go back a little bit further, I forget, but certainly in this we've got over a week of trading, and we're just going sideways. Then what happens? We gap down through it and break down and bust below that. Weakness, meaning that most of this stuff in here has probably been selling. So this isn't going to go away real quick, and we can anticipate, as long as we continue to see good weakness in the market, we can anticipate that, if there's 7 or 8 days in here, we've got a bit of time to go to the downside. All right, so we make a lower low, and then we come back up, and we come back up into this area, and we're unable to go higher. We don't get an upthrust here because it's just a testing that goes on, but we're basically testing the underside of this resistance line here, and we fall down from there. All right, now we come in to this area here is the same as this area over here. We come down pretty hard the day before, or 2 days ago I should say, and we make a local high here. We make a lower low down below, and we've got a lower low in here. And now look, we open up and we upthrust this afternoon high, the 2-day afternoon high. But look at what we're doing. We're coming back into all this supply that we saw on the 60-minute chart. So when we can, when we can see this upthrust here on the smaller time frame, it's a nice way to enter our downtrending market that's been making lower lows and lower highs, and that started with a pretty good sideways line that broke hard. Okay, everybody see that? And John says, there's your M pattern. Yeah, your M pattern would be in here. That's right. Okay, good. Everybody sees that. So it's one way to use the higher time frame chart. Okay. Well, actually, I've shown you a couple of ways now with the daily, looking for the daily high. Here's an afternoon high that occurred after we saw some good resistance coming down. Notice too, by the way, that one thing I didn't draw in here, but we can go back here, and I guess on this M pattern, we get, I don't really look for those M patterns. I don't know why. I just don't see them. They should be, maybe I should look for them a little bit more carefully. But what we're trying to do here in this afternoon rally, and also here on this upthrust, is really test in this supply area and coming into the underside of this little support level here that we did see. So that would just add to your technical analysis a little bit. All right. Here's another way to look at this too. Here's IWM on a weekly basis, and we're coming down here, making lower lows. We've got a downtrend in place, lower high here, lower high, lower low, and a lower low here too. So we're in a downtrend, and what do we get here? We get that ABC power cell, right? And right in here, that 3-wave corrective pattern, and then we get an up thrust here. We try to rally up, and kind of a tough one here because it's on a weekly basis. But if we drop down a time frame and read this off of the daily, look at the beautiful little up thrust that we have here. And we have two nice points of resistance before it cascades down. Okay, so that's another way to use higher time frames, looking for some of the and I've hinted around that, or not hinted, I think I've talked pretty directly about this. If you see, the up thrust on a higher time frame, and here we've got a power cell on it with an up thrust on a higher time frame, we can look for a better entry on a shorter time frame. Okay. Good, Wesley. I'm glad that was helpful. That was an up thrust of the first lower high on the 15-minute. Yes, Alan, that's right. That other chart was the first lower high. That's right. But it was an attempt. It was the afternoon high. I often look at, when I'm trading the S&Ps, I'm often very cognizant, especially if we've had a big push down. I'll go back to that chart. If we have a good push down here, like we did here on this day, actually it bled over a couple of days, and then we rally up, I'm very aware of the afternoon high here the next day. Often we'll see an opportunity to trade against that the very next day. We didn't get it this day. It didn't come until the day after. But it's something to be aware of if you're trading the S&Ps, the afternoon highs after a good swift move down. All right. I think we're coming to the end here. Yeah. So just as a little bit of a summary here, we've talked about the elements of really a family of up thrusts, or a series of up thrusts. The kind of classic up thrust, the hidden up thrust, the power cells, different ways of looking at it. I've talked a lot about conceptual maps. I think it's really important because you could see all these different examples. There no two are really identical. So you really have to have grounded in your head a nice conceptual map of what we're looking at. And so we looked at conceptual maps of up thrust, hidden up thrust, power cells, and the like, and also trading ranges, and downtrends. And we've kind of defined those as well. We spent a lot of time on background conditions, or what I also call structure, looking at what the structure of the market is. And it's not to say that I can tell you what every market structure, every bar on the chart is going to tell us, but you can start to piece things together. David Weiss, who taught me how to trade, always talked about developing a story. And that's kind of what we do here when we're looking at, the shortening of the thrust, and then the weakness coming in, the supply coming in, and this change in the wave structure. It's a story that we're crafting or constructing about what's going on in the structure or background of the market. And then the trigger is the up thrust, or if it's, too much for our risk, then the trigger, comes a little bit later on maybe a smaller time frame setup. But the up thrust is a clear, clean sign of weakness in its own right, and then becomes part of our background or market structure story. And so I spent a lot of time on that because that's really crucial in trading anything. We've talked a little bit about when up thrusts fail, when we're in an uptrend, when strength appears in the market, or when we get absorption. And even when we see these fail, we also talked about the market is many times, I shouldn't say most, but certainly many times forgiving. And if we can recognize that we're in a failing up thrust here, we often have a chance to get out maybe with a small profit or break even or just a little bit of a loss. We talked about entry options. We talked about exit options, those being sort of personal decisions. We talked pretty good detail, I think, about the setup criteria, and then some additional tips and examples, really looking at leaning against that resistance when it's occurring, because a lot of times we're going to see it multiple times. They're just pounding and trying to pound, and the old adage of 3 times and it's going to break up through the resistance and go higher. Well, we saw several examples where that's not the case, and so look for that upthrust when they're pounding up against that and creating multiple levels of multiple points of resistance there along that resistance level, because it's often a good spot for an upthrust to occur, and if it does, it's a nice trade. We also talked about power sells, and when they can occur, and looking not only at upthrust but hidden upthrusts there, and we looked at multiple time frames, or looking at higher time frames and framing out a market, and then looking for the upthrust opportunities on the smaller time frames. So I hope that's been helpful for you. You've gotten everything that I know about upthrusts. I don't know anything more about them. I promise you that. What it takes now is to probably listen to this a couple of times, and this will be posted up shortly for you to listen, and to go back to your notes and stuff, and then to look at market after market after market. Look at example after example after example and get really familiar with them, and then start trading them. Trade them small amounts at first. Paper trade them. I'm a big believer in paper trading, and then go small, and then when you get really comfortable with them, they're a really nice trade setup. All right, everybody. So we went almost an hour over. I apologize for that. And so I'm getting some comments here. Good. Great. Okay, good. Thanks, Wesley. I appreciate that. Laura says, for learning more about wave structure, can you recommend a book or a place one can learn this? I can't. I've never seen it really in a book. Wyckoff talked a little bit about it, but really between the lines. One of these days I'm going to put together a seminar or a webinar on structure, and I'll let you know, Lars, when I do, because there's a lot to it, and there's a lot of good stuff to do with it. But you got a good amount of it in here. I mean, there's variations on it, but you got some good stuff here. So really focus through on this. And if you got questions about it, Lars, send me a chart. I'm happy to try to help out with that. Thanks, Curtis. I appreciate it. And Debbie, that's always great to have you and Eric in. So that's good. I'm glad you're both here. Thanks, Gary. Appreciate that. John, appreciate it. Thank you. And William, I'm glad to hear you got something out of it. That's good. Thanks, Scott. Appreciate that. Great, everybody. Oh, this is nice. I'm blushing now from all this. Thank you. All right. Thanks, everybody. That's good. Oh, yeah. Wesley just said something. Lars, David's book is coming out in December. David Weiss. It's already up on Amazon. I think you can look for it there. So I haven't looked at all the chapters out in that, but there'll be some of that stuff on a lot more as well. I mean, that's a book without hesitation, I'd recommend that. You'll see some stuff on structure now from that, but you have to wait until December. Thanks, Mike. I appreciate those comments. All right, everybody. Thank you all again, and good trading, everyone. Trade mindfully. That's my sort of theme here, and part of going through the background is being mindful in the markets when you're trading, and it's one of the ways to ground yourself mindfully and do that. So, listen, everybody. Good trading. Thank you all, and I'll see you on the blog and in other events, I'm sure, in the future. Take care, everyone. Thanks again, and bye-bye now.
3 hours. When